Good morning, everyone. Nice to see everyone again today. So it's the 5th anniversary of We Are In conference. And I just wanted to start by a big thank you to the ECB for the great hospitality for the conference, to the entire organizing team, and in particular to the locals, Katarina and Agnese, and also to Carolina, Fiorella, the BIS, the entire program committee, and also obviously to all of you here, all the speakers and discussants, and to the CEPR staff, Petra and Despina. Now, it is my great pleasure to introduce Philip Lane, with member of the Executive Board and Chief Economist of the ECB. Philip's career is so extremely distinguished that I'm not even going to try to list all his achievements. Besides his key role at the ECB, Philip's intervention in the public debate are always very clear and substantial. I read all your speeches. I always find them extremely enlightening. I should also mention that Philip is a CEPR Research Fellow since 2002, and so that's a great achievement. He is an extremely well-cited international macroeconomist. And for example, all of us know his famous paper on the voracity effect with Aaron Turnell. He has also been a very important pioneering contributor in the new open economy macroeconomics with new Keynesian models. He has obviously also extremely influential work on the external wealth of nations with Gian Maria Milesi Fioretti. That has been absolutely path-breaking work in international macroeconomics and finance, and certainly it has greatly inspired my own research. So Philip, I'm delighted to welcome you here on stage.
So let me thank the organising committee for inviting me. I'm really happy to be able to participate, and I think the programme both yesterday and today has been really excellent. I think that poster format at lunch yesterday was really effective. Unfortunately, for some reason, after this speech, I have to go to the executive board and kind of make decisions about the budget and so on for the ECB, so I won't be able to stay here. And let me thank Hélène for the very nice introduction. I think we're of the same generation, so we've kind of, which is very nice as you get older. It's very nice as you get older to have people who've been on the same generational cohort as you and to really explore these topics. In any event, what I want to talk today, because again, this is a macrofinance conference, and the topic of how monetary policy transmits is really at the intersection of macro and finance. So what I want to do is really, if you like, uncover the veil behind a lot of the monetary transmission analysis that is done here at the ECB. So let me thank the group of ECB staff who've really put together the analytics I'm going to show. So I'm just the reporter here. The actual work gets done by the ECB staff. The nature of monetary policy is we meet every 6 weeks, which means that a lot of this analysis is basically in a perpetual update. It's a perpetual update because the same models are kind of re-estimated, reassessed every few weeks. So again, for those of you both in central banks and academia who develop analysis, develop models, you may not get cited by us because a lot of that work is confidential, but there really is a kind of exploitation of the intellectual property developed by the macrofinance community. Okay, so in any event, and on the ECB website, you can read the full speech, but I'm not going to stand here and read very technical sentences, which might be a bit difficult for you to follow, and also it would take too much time. So what I'm going to do is kind of convey with some of the main charts and so on from the speech. Maybe my download count can go from Hélène. So usually my speeches might get one download. I now know it's Hélène to more than one download, in the online data. So let me just start with a very basic issue. And I'm not so sure the other central banks articulate how to make monetary policy in the same way. But this is a standard paragraph in our monetary policy statement. And if you like, we've decided we're not going to provide forward guidance in the sense of saying, look, all else equal, we think the interest rate, the dot plot or the interest rate is going to be X, Y, and Z if conditions are maintained. But what we want to do is to help the outside world try and, if you like, have the ability to, if you like, reverse engineer or shadow what we're doing. And so what we say is, what is the goal? It's 2% in the medium term. It's not 2% every quarter, but in this incredibly precise phrase, the medium term, we want it to be at 2%. We say, in line with what I just said, we're going to not pre-commit. So in every meeting, we're going to look in an integrated way at the data and then make our decision. And you might say, well, tell me the data you're going to look at. And it's going to be the inflation outlook. And I think you can think of that like as the most likely part. What is the base case for inflation? The risks surrounding it. And of course, I think everyone now is elevating emphasis on this issue, which is, okay, maybe that makes sense under the baseline, but are you sure it's robust to any particular list of upside and downside risks? And then a cross-check with the underlying inflation dynamics. And what I want to focus on today is the strength of monetary policy transmission. Now, I don't know how many of you have tried to think about that question. How does monetary policy transmit to the economy? And then you get into a lot of questions. Is this a systematic monetary policy, which is predictably responding to some shock to output or inflation? Or is it a monetary policy surprise, where compared to what the market expected, you've done something surprising? So that most basic anticipated versus unanticipated is there. It very much depends, and maybe I'll come back to this throughout the speech, in terms of if you look beyond the representative agent. And there's a lot of Hank thinking at the ECB, because of course it depends on whether, and behavioral economics as well, it depends on whether people are really forward-looking. So the expectation of an interest rate hike 5 years from now matters for behavior today, versus people who are more heavily discount the future and are more focused on the actual policy decision. It varies a lot across models, and every so often I think the ECB staff publish, here's how much investment moves, consumption moves, inflation moves to 100 basis point shock, depending on the macro model you use. And that idea of model robustness is also very important. So with all of that is you cannot say, I have the perfect model, I read off the monetary policy impact of that model, and I'm done. It makes more sense to really understand what's happening in the data, and that's what I want to try and do. So maybe the first step in that sequence is to ask, is monetary policy effective in moving the broader set of financial conditions? I mean, obviously, if you're paying attention to the current developments, there's a big debate in the US about whether the impact of the equity markets, private credit and so on, means that monetary conditions are looser than might be expected from the policy rate. So that's a very basic cross-check, is when we move the interest rate, do we move broader financial conditions? And how do we aggregate financial conditions? It's basically the best predictors of future inflation and output. So it's the elements of financial conditions that predict where output and inflation are going in the future. And that's why it's a macro financial conditions index. So in the left panel there, the orange line is our policy rate, and the blue line is the overall index. And you can look at that in two ways. One is, it looks like there's a strong correlation. So a lot of the time, the policy rate does seem to drive financial conditions, but there are plenty of exceptions. So there are exceptions during the global financial crisis, at the start of COVID, and so on. So what I want to emphasize here is when you think about this index, which is kind of normalized to zero, what we've had now is when we started hiking is a really big change. we went from accommodative to tight very quickly. That's a steep movement, both in the policy rate and in financial conditions. It's unwound, but only partially. So the level of the financial index now is still tighter than the historic norm. And that's a really important feature of where we are. Essentially, before the pandemic, financial conditions were priced on low for long. People believed we were in a chronic low inflation environment, requiring basically open-endedly remain at the lower bound as far as the eye can see. What we have now is a resetting. There's an anchoring of inflation expectations at the target. And we have not just the policy rate, but long rates, real rates, all of these have moved. The other point, if you stare closely at the last few data points of that, is there has been an easing from equity markets in the last few months. This is the dark green smudge below the zero line. But it's just, the equity market is just not big enough in Europe. It's not a big predictor of future output. So the contribution of the equity market to financial conditions in Europe is limited. So it's possible simultaneously to be concerned that the scale of kind of market pricing in the US is creating loose financial conditions and not have the same concern in the European data. And then the right chart is just basically saying this new index is comparable, if not a bit better, than some of the other indices. Okay, so that's one cross-check. Is our policy rate correlating with overall financial conditions? The second cross-check is, are we affecting the banking sector? The banking sector remains, super important in a European case. And again, when you get a chance, it might be easier to look at those graphs on the website to look in more detail. But basically here, the staff are looking at different easing episodes at different points in time over the decades. And the message here is we do have pass-through to lending rates to firms and to households. So we do have an effective pass-through. Let me say that's not obvious. The history of the euro area has been from banking systems that are not working properly. So if you have a banking system that's not working properly, it's not necessarily the case that the transmission to lending rates would have been so smooth. But one of the big payoffs over the last 15 years has to raise the capital ratios of banks, make them better performing, and what do we get? We get stronger pass-through into the lending rates relevant for firms and households. But let me emphasize that the decline in the lending rate since we started cutting rates for households, for mortgages, has not been that big. Because remember, mortgages are priced off the long end of the yield curve most of the time, unless you have a kind of a floating rate mortgage. And these rates, as I say, have had a permanent increase. Compared to being very low before the pandemic, they're now 2-something by and large. So there's been a 2 percentage point increase in lending rates, which it looks like it's persistent. So if you're trying to say, well, why is the housing market still in many countries fairly muted? Households have to get used to this world where the cost of a mortgage is much more expensive than it was before the pandemic. And here at ECB, there's also been work reminding you that some people have insulated themselves by having a fixed rate. But a lot of these fixed rates in Europe are 5 years or 10 years. As they roll off a fixed rate they took in 2019 or 2020, they face a higher rate. So even though we've cut the policy rate, many people in the mortgage market, when they refinance, it's more expensive. And again, that's a counterweight to easing. So what we have is essentially an interesting fact that essentially the left side is coming from surveys. We have seen a recovery in demand for loans from households. Not much from firms. So part of it is this new interest rate world, and part of it is look at the shocks facing the European economy in terms of trade, in terms of uncertainty and so on, in terms of the Russia-Ukraine war. And so when you try to think, Are we back to normal? On the right side are these credit gap ratios. So some of this are in regulatory mandates to calculate a credit gap. But in general, it's a kind of a goal to say what is a kind of reasonable ratio of credit to GDP. And if you look at that distribution, it's mostly below zero. In other words, credit is lagging GDP in this time period. And the question is that suggesting either that we have this permanent shock to interest rates, or that it's just a lag, it's going to catch up, or have bank credit just become less important? So maybe you should look at non-bank credit, private credit, and so on. And it's simply a change in the structure of the financial system. Well, if you look at how firms finance themselves, and here we include all sorts of finances, not just bank finance. You can see from that graph, it's still pretty quiet. So if your conjecture was bank credit is muted because non-bank providers of credit have expanded, that's a very important story in the US. It's not zero by any means in Europe, but it's not big enough to replace the shift in bank credit. A very interesting issue, and this has been here for a long time, but now with new data sets, and again, I don't know how those of you in academia, how much you've been able to think about these new data sets, such as ANA Credit. So ANA Credit is a big data set, basically recording loans above a certain size across all sectors in the European economy. So you can now ask questions which you could not ask before. Now, there are other loan level data sets at different national central banks and national agencies as well. But if you look here, there's some clear patterns. So on the left pattern, what we see is a big difference between manufacturing and services. So one reason why credit has been muted is, of course, the manufacturing sector, both for equipment and for working capital, typically uses a lot of bank finance. But the European manufacturing sector has been shrinking in many places in recent years because of the rise of China, currency appreciation, high energy costs, and so on. So again, if you're trying to say, okay, it's monetary policy, where is it effective? It looks like it's effective more in the services sector right now rather than manufacturing. But within services, let me emphasize, it's really the green box there is real estate services. So there's a lot there in relation to real estate. And then the other graph on the right panel is indexing by size and riskiness. So what's happening under these conditions, which I think from the point of view of an individual lending officer makes sense, is credit is flowing to large firms and less risky firms. Probably a lot of incumbents. Credit is not flowing so much to smaller firms and riskier firms. So I see various people here teaching business schools, and I'm sure when you think about innovation rates, productivity, dynamism, if credit is not flowing to smaller and riskier firms, then the impact on the economy is going to be more limited. So again, this shows the value of, these were questions I think we couldn't answer years ago. Now we have, I think, important ways to kind of capture that. So in relation to bank loans to households, I said there's been, in the aggregate, a significant increase. Part of that is essentially, as we've cut rates, many households now can, it's interesting, some of the models used in kind of abstract macro seem to work when you think about demand for housing loans. So Tobin's Q, other user cost of capital works quite well for housing. As we've cut rates, it's been more attractive to think about returning to the housing market. But what you see here is two factors. One on the left, there are differences across countries because it's still the case the mortgage market is very national in nature. This may reflect kind of social norms, it may reflect legal incentives, but of course the pass-through from the policy rate to mortgages will be faster if there's floating rate mortgages than if you have long-term fixes. That topic has been here throughout the history of the euro. People like Rudy Dornbush in the mid-90s were writing papers about how will the euro work with this asymmetry in transmission across countries. And then the other innovation on the right is what we have now, which again, maybe you all are up to speed on it, but this consumer expectation survey. So every month we survey a lot of households in Europe. And this really helps us think about differences across income cohorts and other characteristics. So what you see on the right is there's a lot of asymmetry across income cohorts. I mean, the bottom quintile, they don't have the status to apply for mortgages. What's interesting is the second quintile has the biggest. And this can be interpreted actually more as a sign of financial pressure. These people have seen big increase in the cost of living, and so they really need to kind of find financing. Now, you might say that that's really part of an effective monetary policy transmission. These are probably high MPC households. So easing interest rates that have an impact on this group may be something that's quite important. Much less so at the higher quintile groups. I'm now going to get in severe trouble with my board members upstairs. So let me turn to some other factors here. One is uncertainty. I think you might agree measures of policy uncertainty have gone up, even if financial markets on the right don't seem to price that so much. But what I want to emphasize is uncertainty affects monetary transmission, both in terms of credit demand. Firms and households typically a lot will postpone decisions under conditions of uncertainty. But on the credit supply side, risk is a big part in our surveys of whether a bank is prepared to make loans on easy conditions or whether they want to hold back. So if you're working on how does uncertainty affect the economy, the impact of uncertainty on the decision, the credit supply decision, I think is important. I'm not going to be able to speak coherently about trade beyond saying on the right side, so far the message is banks are more nervous about firms exporting to America than firms importing from America. And again, we're keeping track of that. So again, if the question is, how does trade policy affect the economy? In addition to looking at real channels, looking at the channel in terms of credit supply is also important. So I'm going to maybe just finish with the effect of not just trade policy, but the exchange rate on again, banking systems. So Helen mentioned earlier on the work I did on external balance sheets. But a big part of external balance sheets are the balance sheets of the banking system and more generally the financial system. European banks have a lot of activity in dollars. The good news, it's on both sides of the balance sheet, so a lot of it nets off. But you still want to go bank by bank, item by item. And let me emphasize here, there is a difference in terms of funding. A lot of the liability side is raised from non-bank financial entities. So, one of the big discussions last week at the IMF were the interconnections between the non-bank financial system and the bank financial system. It's been stable and smooth, but, the financial stability wing, I'm sure, has to worry about this kind of dynamic. Okay, I've kind of bounced around there, but if you want the one sentence takeaway, which is, if you say, well, I carry around an elasticity that output or inflation responds to the interest rate by X. Okay, in the end, we do have that kind of macro elasticity, but behind it, we do really have to go meeting by meeting, because what I showed you just there is monetary transmission depends on the shocks hitting the economy. So those shocks have an effect on the real economy, but they also have shocks, impacts on how banks make decisions, non-bank make decisions. And this is why in our overall monetary policy strategy, maybe for those of you who are historians of the ECB, we used to have a segregated analysis. You'd study the real economy over here, and you'd study monetary aggregates over there. And it was like a cross-check. Now, 5 years ago, the strategic decision was you need to do it jointly, because the intersection of macrofinance runs both ways. And so the overall message, and this is why probably the ECB is so happy to have this macrofinance conference here, is macrofinance is really so central to monetary policy. So with that, let me wish you all the best for the rest of today, but I now have to sprint. Okay, thank you.
Okay, well, after this fantastic speech, once more we learned a lot about transmission of monetary policy, a topic which a lot of academics have been working on, and there's still a lot of mysteries, so still a lot to discuss. We are going to shift to another very important topic, especially in the current context, which has to do with the intersection of economics and geopolitics. And we are going to start with Beata.
Thank you. So thank you very much for including our paper on the program. This is joint work with Giancarlo Cossetti and Banu Demir, and it's about geopolitics. We have seen lots of geopolitical tensions, and one of the dimensions of geopolitics is introduction of sanctions. And even though sanctions have been proliferating in recent years, we actually have a fairly limited understanding of their implications, particularly their implications for third countries. So this is what this paper is about. If you have a situation where sanctions restricting exports from sanctioning economies create a vacuum in the market of sanctioned country, that creates an opportunity for third countries, countries not participating in sanctions, to step in and increase their exports. But firms from those countries have to trade off the opportunity to make profit against the heightened risk of reputational damage and potential secondary sanctions. They also have to take into account the possibility of higher transaction costs and higher risk of non-payment. You know, if you are trading with a sanctioned country, it may be much harder for you to actually do anything if you don't get paid. So in this paper, we have a theoretical framework and empirical analysis looking at this trade-off between increased business opportunities and the increased risk of reputational damage and secondary sanctions. And our empirical setting is Turkey, which is a country not participating in sanctions, but which, due to Western sanctions on Russia introduced after its Russian invasion of Ukraine in 2022, suddenly found itself in a situation where it saw export opportunities in the Russian market. Let me remind you about sanctions, what has happened. Now, Russia started its full-scale invasion of Ukraine on February 22nd, 2022. Western countries responded very quickly with sanctions. These sanctions, among other things, restricted Western exports to Russia. These are exports of military goods, dual-use goods, industrial goods, and luxury goods. Also, most, but not all, banks operating in Russia have been cut off from the SWIFT messaging system, making it much more difficult for them to process transactions in Western currencies. Now, most of the sanctions that I mentioned, these are the sanctions that are relevant to this paper, have been in place by March 2022, so essentially a month after the invasion started. Now, there are many other sanctions. You know, the EU is at the moment on the 19th sanction package, but sanctions relevant to our study were actually introduced by March 2022. And now, from the academic perspective, this is a good laboratory to study the implication of sanctions because of their comprehensive nature and the economy that's subject to sanctions being very large. Right? In many sort of previous episodes, much smaller economies were sanctions, while before the invasion, Russia was 11th largest economy by market exchange rates. And what's very important to understand the context of our paper is Turkey is not participating in sanctions. Right? So that means that firms that operate there are not doing anything illegal if they supply the Russian market. But of course, there is one thing what's legal, what's illegal. There is another thing what the public expects firms to do. In a very nice paper in the Economic Policy, Hart and co-authors produced a survey of 3,000 Americans, and they were asked about their perceptions of how firms should behave vis-à-vis Russia. And 61% of respondents agreed that doing business in Russia is like being an accomplice to the war. So basically what that means is that the public has very high expectations about how firms should behave, and the public expects that firms should cease supplying the Russian market, whatever the cost. Right? So the authors of that paper conclude that actually very few people believe in Milton's Friedman saying that the business of business is business. No, people actually have much higher expectations. And if you have been following the press, Raiffeisen Bank has been under a lot of criticism because it continued its operations in Russia, as have other entities, including the French supermarket chain Auchan. And there have been a lot of firms, a lot of Western companies that actually decided to exit the Russian market in order to avoid the reputational damage. Now, the other risk that you need to trade off if you are doing business with a sanctioned country is the risk of secondary sanctions. What are secondary sanctions? Their aim is to prevent third parties, right? So entities from countries not participating in sanctions, to prevent them from doing business in countries under sanctions, right? So prime example is, when the US reimposed its sanctions on Iran, it imposed secondary sanctions on non-US entities doing business with Iran. Right? And these sanctions can be very painful. The most severe consequence of US sanctions is cutting off firms from the US financial system, which essentially means you cannot do any transactions in the US dollar, which cuts you off from the US market, both on the import and export side. So looking at the Turkish context, when you look at the residualized Turkish exports to Russia, that's the solid line, and you compare them to exports to the rest of the world, you see the red line, that's February 2022, that's the month of the invasion. There is a dip the following month, and then these exports to Russia go up relative to exports of Turkish firms somewhere else. Now, in this paper, we utilize very, very detailed data. Essentially, think of this as transaction-level data. So we know which firm is exporting. We know ownership of that firm. We know the product they are exporting. So these are, if you are familiar with the trade classification, it's 8-digit products, so that's several thousand products. We know the month in which they are exporting. We know the destination country. We know the currency used to invoice this transaction, and we also know the payment method. That's actually something that's unique about Turkish data. We exclude re-export, right? So, there is a separate question of, firms engaging in sanction busting by importing, as intermediaries and exporting further. That's not something we are interested in. We are interested in this decision of firms weighing these export opportunities against risk of sanctions. Now, we have a theoretical framework which builds on work of Crowley and Schmidt-Eisenlohr and co-authors. Essentially, in this framework allows us to think about trade-offs firms face when deciding on currency of invoicing. And actually in the paper, we show that indeed there is a strategic complementarity matters when firms choose which currency to invoice. Operational hedging reasons matter, financial costs matter, but the interesting story really here is the reputational risk. And that's what I am going to focus on. I am not going to talk about other results we have. So, baseline empirical result. So we are doing standard diff in diff, where we look at an outcome related to trade. So think about value of trade, firm F exporting to country D, destination country D, a product P, again, very detailed product classification, several thousand products in a given month. Right? And then we are asking, are exports from Turkey increasing more to Russia than to other countries after the war starts, essentially after the imposition of Western sanctions, where March 2022 is where this indicator for the post-period kicks in. Now, we are including firm product destination fixed effects, right? So we are looking at a given firm exporting widgets to Russia, let's say, and we are, or the same firm exporting widgets to Germany, and then we are asking, are exports to Russia increasing disproportionately after sanctions kick in? Right? So anything that's related to ability of firm export the given product to a given destination, right? It's sort of taken care of. So we are using the variation over time. Then we also have product month fixed effects, right? So if there's something happening in global markets, with demand for widgets or Turkish ability to produce widgets, that would be netted out. And finally, we have firm month fixed effects, right? So if firm is going through some turbulence and, they are able to produce less or more, that's taken out, right? So within firm month, we are looking, are they exporting more to Russia of a given product than somewhere else? And then we also do a standard event study. Okay, so what do we find? Well, whether we look at value of transactions or quantity, we find that firms from Turkey disproportionately increase their exports to Russia, right? So the war started, European sanctions meant that European and actually US, so Western exports to Russia essentially disappeared. That created a vacuum, and this vacuum is now to some extent being filled by Turkish exporters. Now, if you look at the event study, you see drop in the first month of the war, and then slowly exports are being ramped up and stay at a higher level. But the really interesting question is, are all firms behaving the same way? Now, if you think about who is under greater public pressure and who is more exposed to potential Western sanctions, well, affiliates of Western companies come to mind, right? Because affiliates of Western companies are more visible. They are multinationals. They operate in many markets. They are subject under pressure from their own country, from their own customers elsewhere. They are more visible than other firms. They are much more, on the screen of agencies interested in imposing secondary sanction. And that's indeed what you see. While Turkish firms are enthusiastically exporting to Russia, increasing their exports to Russia, this is much less the case for affiliates of Western multinationals operating in Turkey. Is it just now? Is it the threat of secondary sanctions, or is it reputational damage? Right, the risk of reputational damage. So if you look at the right-hand side, when we focus on exports of products that are subject to Western sanctions, you see that our results are confirmed, right? So if firms if Western affiliates operating in Turkey are unwilling to supply the Russian markets with products that are subject to Western sanctions, that is likely that that's because they are concerned about the risk of secondary sanctions. But perhaps more importantly, you see that they are also decreasing their exports of non-sanctioned goods. And that's, and that means that it's the reputational damage rather than concerns about secondary sanctions that are working here. Is this about just Western multinationals, or is it true of all multinationals? So we allow for a separate interaction with multinationals from other countries. Remember, it's only 45 countries that impose sanctions on Russia. And you see that it's only Western multinationals that behave this way, that multinationals from other countries are behaving in the same way as Turkish firms. Now, what are the margins of adjustment? There are several. Well, first, we ask, are Western firms more likely to discontinue supplying the Russian market altogether? Right? So now what we are looking at is exit. Is a given firm F exiting from market D? So what we find is that during the period that we consider, Turkish firms are less likely to exit the Russian market than they are to exit any other market. But Western multinationals are actually exiting the Russian market, and you even see it in the raw data when you do simple counts of firms. So they are 18% more likely to exit the Russian market than any other market. Now you may also focus on the intensive margin, so on continuing exporters, and you see that continuing exporters decrease their exports to Russia more than to any other market after the war starts. We also can look at whether firms introduce new products. So you see that Turkish entities are more likely to introduce new products in Russia rather than in a different market, but Western multinationals are not doing that. Now, I mentioned that doing business with Russia in terms of processing transactions is hard because majority of banks operating in Russia have been cut off from the SWIFT system, right? And you see it here that firms are decreasing the share of their exports that are denominated in Western currencies. So you see that after the war started, Turkish firms decreased the share of their exports denominated in the US dollar by 5 percentage points and their exports denominated in euros by 3 percentage points. And what is happening? Well, what are they doing? They are increasing invoicing in Turkish lira. And, if you, in a sort of separate work, I look at the other side, I look at what has been happening in Russian imports from the world, you see very clear shifts away from the US dollar as a vehicle currency, as an invoicing currency, and shift to producer currencies, and a shift to renminbi as an international currency. So there are quite pronounced changes. Now, if you have been following what has been happening to the Turkish lira, you may have doubts about whether this is a good decision, right? There has been a lot of volatility in Turkish lira, so why on earth are these Turkish exporters invoicing in lira? The answer is very simple. They are demanding cash in advance. So the share of exports that are going on cash in advance terms has increased by 6.5 percentage points. So they are getting paid before shipping the goods, and that's consistent with protecting themselves against the risk of non-payment, and that's also a way of dealing with the volatility of the currency of invoicing. Now, what these firms also do is they are increasing their prices. So we can look at unit values, right? So this is the value of the transaction divided by quantity, and you see that that Turkish exporters are increasing unit values by about 4%. Right? So that's actually, I must say that if you look at Russian import data, you see similar numbers. So the price of goods that are being imported by Russia is actually not increasing by tremendous amount. Interestingly, Western multinationals are not behaving differently from Turkish firms. So those that still continue exporting and supplying the Russian markets, they are also benefiting from the higher prices. Now, Giancarlo and his co-authors, they have come up with a method for netting out markups from the trade data. Essentially, this is based on demeaning, by firm product and then by firm product and the trading pattern. I'm not going to go into the details, but the bottom line is that if you conduct that procedure and you net out proxies for production costs of products going to particular collection of markets, you find very similar result to what you see in the raw unit values. Markups go up by 4%, and there is no difference between Turkish exporters and Western firms in terms of this increase in markups. Now, how important are these barriers, these, in a sense, self-imposed restraints on supplying the Russian market? Well, what you can do is, using trade elasticities, you can express them as in terms of equivalent tariff. Right? Now, of course, the literature has a wide range of estimates of trade elasticities. So here we've done calculations for several of them. But essentially, these self-imposed restrictions by Western affiliates by Western multinationals are equivalent to a tariff, between 25% to more than 300, depending on which elasticity you assume. So, they are not insignificant, and I think in one of our back of the envelope calculations, we show that they are foregoing the opportunity on average to export about $50 million. Now, the final question I want to mention is what always comes up: is, are these firms increasing total exports, or are they pulling goods that they were sending somewhere else and now redirecting them to Russia because the profitability of those exports is higher? Now, there isn't a sort of obvious way of doing that, right? Because you want to look at total firm level exports. So you need to somehow link that to the opportunity to export to Russia, But of course, everything could be endogenous. So what we do is we ask: is it the case that firms who were exporting more to Russia prior to the war, in terms of the share of total exports, do we see that they increase total firm level exports more? And that is true. Right? Second, we ask: is it the case that firms for whom goods that would come under sanctions in 2022 were more important in export portfolio? Are those the firms that see their total exports going up? And the answer is yes. Right? The logic here is that firms are happily exporting. Suddenly, sanctions come in. European exports of sanctioned goods to Russia disappear. So there is particular export opportunity in those particular goods. So those firms that were exporting more of those products in general have the ability to do it. And that's exactly what you see. You see this for all firms. You see it for you see it for Turkish firms, but not for Western multinationals. So here, others are meaning firms other than Western multinationals. So to conclude, we consider the impact of sanctions on a third country not participating in sanctions, whose firms have to consider the trade-off between export opportunities and the risk of secondary sanctions and reputational damage. We show that this risk indeed seems to matter, as Turkish firms behave differently from Western multinational. Turkish firms take advantage of the export opportunities, while affiliates of Western multinationals operating in Turkey choose not to do so. The results are consistent with both reputational effect and the threat of secondary sanctions being the drivers, because we see similar behavior when sanctioned goods are being traded, so goods subject to Western sanctions, as well as non-sanctioned goods. And we also see that risk of non-payment shifts firms to demand cash in advance, and also difficulties of processing payments in Western currencies shift firms to rely more invoicing in Turkish lira and less on invoicing in the US dollar or the euro. Thank you.
Thank you very much, Beata. And the discussion is Theodora Tefi.
Yeah, first of all, thank you so much for inviting me. Thanks so much for giving me the chance to discuss this super cool paper. I'm first going to summarize a little bit, although Beata was super clear. And then I'm going to go through like my main comments. I don't have that many, but I'll promise I'll have something that we maybe I can use later to discuss. So what does this paper do? So it essentially asks how are Turkish exports to Russia affected by Western sanctions on Russia? Why is that interesting? Well, because Turkey did not impose sanctions, so this is really a third country effect in a sense. So it essentially takes a step back and says Turkey is not actively sanctioning Russia. So how does a change between in the trade costs between West and Russia affect Turkey? I think this paper does essentially three things. So first of all, it asks in general like the question, do Turkish firms increase exports to Russia relative to other destinations? Then it asks, does reputational risk limit firms' ability to benefit from the new export opportunities? And lastly, it also tries to speak a little bit on the margin, as Beata was saying. I gotta say, like the presentation is much more streamlined. As in, when you read the paper, especially in the beginning, it's not 100% clear like what exactly they want to focus on. But it becomes clear later on, like that it's really the reputational risk. So how do they do that? First of all, they have extremely cool data. If you work in trade, I'm sure you've heard about the Turkish firm-level data because they're really great. They are, yeah, as Beata said, they're pretty unique, especially because they record this payment. So more information on on the payment choice and so on. So it's essentially the main specification is a relatively standard diff and diff. So maybe just to note, it's like at the firm level, and this allows them to include a very, very rich set of fixed effects. So I think the most important one being like that they have the firm, product, and destination fixed effects. So they really only look within those cells and only use variation over time. They have, I think, like 4 sets of results. The Turkish exports to Russia increased by 33% relative to exports to other destinations. The reputational risk really matters, and so that means it constrained firms with higher Western exposure from expanding trade with Russia. Turkish firms adjusted by switching to cash-in advance payments and invoicing in Turkish lira to reduce risk exposure. And lastly, also, there is an exit of, the exit of Western competition increased Turkish firms' market power, leading to higher prices and markups in the Russian market. As I mentioned before, so the set of results that they really care about is like the reputational risk thing. So yeah, this paper is great. I recommend to all of you who are interested in this kind of topic to read it. So now let me just briefly talk about like the four big, or not so big, but like the four points that I want to mention. So first of all, like that's actually my biggest comment. I think so. It's not that surprising that Turkish exports increase. So this is actually a very standard result that we would expect just from standard gravity type of standard gravity theory in a sense. So what happens is the trade costs between West and Russia go up. And that means automatically that everyone else is going to trade. So everyone that is not involved in the sanction regime is going to trade more with Russia. So that's something we would just expect naturally. So that's something that gravity gives you essentially, which we call trade diversion. And so I think, so that's why. So the way that the paper is set up, I mean, you essentially get like a number, so by how much Turkish firms gain, but it's not necessarily telling you that much, like how much we should expect it to go up. So my point being, if you think, so the ideal counterfactual will be that you have a world where you see once sanctions, and then, for example, a tariff between, so just a normal tariff that goes up between Russia and the West, and then you would compare those two coefficients, and then the differential between those two coefficients, that would be the interesting part in a sense, because that tells you how much, because of the reputational risk, the Turkish firms are not reaping all of the benefits. So it will be what I just described. That will be one way of doing it. Another way would be to have a full set, like a full GE type of model that we have a lot in trade. Why? Because also there you could compare what would we expect, like in a world where we're not in a sanctioned world. So how does that relate to? Or how does that compare to a world where we have sanctions? And so you can really isolate like the reputational cost. Yeah, as I said, maybe. So I think I see two alternatives here. One way would be to go with like a full scale like GE model type of thing. I don't think that's like the flavor of this paper. So if the authors wanted to do something along these lines, they could, for example, use the Trump of the first Trump administration, those tariffs, because that's very similar, as in there's like a shock between two countries, and then you could check like how that affects Turkish firms. Lastly, so this is a little bit of a cheap comment. So usually in trade, what we would do is we also wanna control for changes in the demand essentially. So in this case, in Russian demand. So what I'm thinking about is, I mean, Russia is going to war, no? Like, so it could be that instead of having demand for like a Louis Vuitton bags, now they really need like shoes for soldiers. And so this is a complete switch in demand, and that could lead to an omitted variable bias. This is something that usually in trade we can easily account for by including essentially importer time fixed effects. In this setting, this is not possible just because the data is only contains one exporter and not many exporters. So that's not really. So in this setting, this is just not really possible to address, but maybe the authors can think about what to do with this comment. And so Beata didn't really talk about the model. We talked about this a little bit yesterday over dinner. So in the paper, there's a section there's like a model in the paper. As of now, to me, it seems a bit disjunct from empirics. So it seems to be focusing not so much actually on the reputational cost, And that is something, so it's much more focused on like the payment side of things. It also has it has very sharp predictions on the payment, but not so much on the reputational risk. So I think here on this, I hope that in like further iterations, this is going to be closer to the empirics and mapped much closer to the empirics. Yeah. Lastly, I was a bit surprised because in this setting, it seems like the extensive margin, so essentially firms dropping in and out of whether they export or not, that matters quite a bit. They talk a little bit, in the paper about the extensive margin, but I was kind of surprised that they didn't use in their baseline results PPML and levels instead of OLS and logs, just because with the PPML and levels, it would include essentially, so it would be a mixture of like the intensive and the extensive margin. In the log OLS, it's just an intensive margin. And then also overall, I think, so I got at times a little bit confused about for which table, which sample it actually is, like that's something I think it could be much clearer on, like just to keep the reader, like to help the reader understand like what exactly is happening, which firms are we looking at and which ones we're not. But again, I think this is something that the next iteration is going to be much nicer. I have a couple of points that I thought about while reading that I found very interesting. I mean, this is not something that I feel like the authors have to do, but it's something I thought was kind of interesting. One, for example, in the event studies, it looks like there's like a little bit of a decrease from June 23 onwards, and I was just wondering whether the authors can say something about that. And then lastly, I know this is probably not part of this paper, but what I would also find interesting is whether you could say something about jobs or something about like more on the Turkish side, so whether this is actually something that helps Turkey to find jobs, because then, so it has important implications in terms of also coalition building. So if Turkey wins a lot by engaging in or like by not sanctioning Russia, then it's going to be very hard to get Turkey on as a part of the coalition. So I have a couple of minor ones, but yeah, exactly. Great paper, so everyone should read it, and thanks for letting me discuss it. Thank you.
Wonderful. So I'm going to leave you the opportunity to respond a little bit, not too long. But,
okay.
Yeah.
So very briefly. So thank you very much, Fedora, for very useful comments. It's absolutely true. Paper is not streamlined, and but there are these things because it is an evolving project, and it has been evolving. The draft has not quite caught up with the latest thinking. But let me respond to 2 points. One is trade diversion. Yes, this paper is about plain vanilla trade diversion, right? But why is it interesting? Some of you may be familiar with Chicago Booth expert panel, where economists are asked periodically to opine on various matters related to economic policy. In March 2022, so a month after the war started, both the European and the American panel were asked the question: sanctions on Russia already in place will lead to, I believe, financial and economic crisis in Russia. 90% of people agreed or strongly agreed, and these are results weighted by respondents' confidence. So economists were very confident these sanctions would have brought about financial crisis in Russia. And in my job at the EBRD, that was the question that I was most frequently asked by journalists: when is Russia going to see financial crisis? Right? So, trade diversion should have been an obvious thing, because if 141 countries at the UN condemned the invasion, but only 45 countries participated in sanctions, but somehow it has not entered the public mind. So, in a sense, what you are suggesting is to compare regular trade diversion under, some sort of trade policy change to trade diversion driven by sanctions, right? That is the point of your first comment. So, the way we think about this is we think that Turkish firms that's the regular trade diversion, and multinationals, that's different behavior because they are worried about sanctions. Second, you ask, is there something different about the portfolio of products supplied by multinationals that made them better or worse positioned to take advantage of the opportunity? So the way we think about this is, again, the sanctioned products versus non-sanctioned products, because opportunities were greater in sanctioned products. But thank you very much for your comments.
Fantastic. All right, so I can see. So I'm going to start, yes, and then...
Thank you. Thank you, Larissa Schäfer from Frankfurt School of Finance and Management and ECB. Very interesting paper. I've actually spent some time at EBRD, very great work that you always do. I have a question about this reputational mechanism, because on the one hand, you're saying that the multinationals are cutting down because they are fearing probably reputational damages. And as I understood, you're not taking this import side into account, but could it be similar what you see in US, that basically the firms, the Chinese firms, are rerouting via Mexico and Canada to US, and a similar thing happens in Turkey, right? That you see more imports maybe from Western countries or even government-owned countries, I don't know, companies through Turkey, because that's also related to the point of the discussion. The portfolio that the Turkish economy is offering is not, product portfolio is not the same as it is in the EU, so it might be that they're rerouting to the Turkish market. Thanks.
And we're going to take... Yeah, we take 3 questions.
Please,
and
please.
okay, Joran and okay. No, Joran, you are second. I insist.
Thank you. You're a Chicago booth. Just curious, how does this compare with trade with India, or let alone China, in terms of magnitude and impact?
Arnaud Mali, CB. I was wondering, Beata, whether you also could use the imports data to shed light on this reputational mechanism. There is a discussion in the EU now on the 19th package on secondary sanctions that we could impose on countries which continue to import Russian oil to fuel the Russian oil machines. So there are goods which are specifically, let's say, likely to trigger secondary sanctions, and whether this could be those ones that could be helpful to shed light on this effect. But paper is super good, so I like it a lot.
So thank you very much for the comments. We are not looking at Russian exports of oil because other people have looked at this. So Elena Rybakova, for instance. So that's why this paper is sort of much more smaller. How does it compare to trade with Russia, with India, China? So, you know, I have other papers that use aggregate data, and essentially you see exports from China to Russia increase. And you know, Turkey and China are the 2 countries where you see the biggest increase. You also see rerouting via Kyrgyzstan, Kazakhstan, Armenia. You see also goods destined to, you know, exports from Western Europe to Kazakhstan, Kyrgyzstan, and Armenia getting lost in transit. So essentially, you know, if you compare what Germany reports as being exported to these countries versus what they report as being imported, suddenly, after the war starts, many of those goods get lost along the way. And this is true for sanctioned goods, not for goods that are not subject to sanctions. So all of this is happening. In terms of the reputational mechanisms and rerouting, so we intentionally excluded re-exports, but you know, there could be something else. So we have a table in the paper where we ask, are these firms exporting goods that they imported from Europe in the last 2 months? And the answer is yes, there is some of that happening.
On this, why did you exclude rerouting? Because that sounds like a very interesting question.
So one reason is there was another team working on that. Okay. I don't know whether they have done it. And then, you know, rerouting you also see in aggregate data. I mean, in principle, you know, we've done the analysis with re-exports, without re-exports, continuing exporters, including new exporters. You know, the numbers, the magnitudes change somewhat, but the message is the same.
But okay. Other questions? because I just had a follow-up on this, but I guess what is especially interesting is also all these dual-purpose goods, right? So in disaggregated data, you can say more about this.
Yes, so when you look at, so we actually do it in the paper. You see that exports of all types of sanctions, goods subject to Western sanctions increase. You see it in aggregate data that, round tripping and goods that get lost in transit, these are particularly goods that are subject to sanction. So you see all of it. Now, we have also another set of results I didn't talk about, is that the multinationals, the foreign affiliates that are most sensitive are those that have US ownership. So essentially, if you have at least 10% of US ownership, you essentially don't increase your exports at all to Russia. Now, we also tried to look at the related question, do you behave differently if you are supplying the Western markets, let's say European Western market? It doesn't seem to be the case. So it seems like the US secondary sanctions are the most scary ones because firms with US ownership seem to react the most.
Very good. There's time for a very last question. All right, then you are gifted a bit of time too. Thank you so much.
Thank you.
And now we have Leslie Shen. Thank you very much, Leslie.
Well, thanks a lot to the organizers for putting together this excellent conference and for including our paper on the program. My name is Leslie Shen, and I'm from the Federal Reserve Bank of Boston, and this is joint work with Frederick Gniepen from the Federal Reserve Board. Everything I say today are our views, not that of the Federal Reserve System. All right, so geopolitical risk has become top of mind for policymakers, market participants, and that's evident if you read meeting minutes from key policy meetings, whether it's the ECB monetary policy meeting or the FOMC, and also if you look into speeches and board meetings by key firms in the economy, such as a quote here from Jamie Dimon from JP Morgan. It's evidence that geopolitical risk is something that people are very worried about. And indeed, there are reasons to think why geopolitical risk may be distinct, because it often involves catastrophic scenarios, expropriation, breakdown of legal order, and extreme uncertainty. Yet, the financial international mechanism through which geopolitical risks are transmitted is still to be understood. As you can already infer from the title of this paper, the focus of this work is on banks. We want to understand the relationship between geopolitical risk and banks. And now, especially global banks, they're inherently exposed to geopolitical risk given their global jurisdiction. And with the outbreak of the Ukraine war, there were a lot of reports that came around that time wondering about the extreme uncertainty of Western banks that had exposure to Russia and the outcomes and how they're responding to that. And understanding this question is particularly important given the long-established literature about the importance of credit supply decisions by banks for the real economy. So for this paper, we're going to focus on two questions. First, how do banks respond to geopolitical risk? Is this response distinct from other macro risks that we have studied? Second, what is the implication for domestic credit supply? So essentially, is there spillover effects? So the focus of this analysis is on US banks. And we're going to conduct analysis into three components. The first component, we're going to construct measures of bank-specific geopolitical risk indices using both established and newly constructed country-specific geopolitical risk index. And the second is the empirical component of our paper. And we're going to ask, how does geopolitical risk shape US banks' foreign operations? And whether the increase in geopolitical risk abroad affect domestic lending. And for this component analysis, we're going to use several supervisory data that the Federal Reserve have access to. And that includes the FRY14Q that many of you may have heard of. That is data at the loan level, and it has information about the riskiness of the loan, the origination amount, and we have information about who are the borrowers and the country of the borrowers. The second data set we're going to use is what's called FFIEC 009. That is a country report of exposures by US banks across the world. So this data is at the bank country time level, and we have information about the exposures of the different US banks. And in particular, we have information about the mode of operation. So we can see, for example, hypothetically, Citibank, how much it is exposed to, say, Russia directly from Citibank US versus Citibank that's operating in Russia, so the affiliates. The form of which we call cross-border claims, the latter is called local claims. And we also have done some work using the SLOOS data, and this is the confidential version of the SLOOS that's at the bank level about bank lending standards. I'm not going to have time to get into detail about that, but this is another margin of domestic spillover that we look at. So with empirical analysis, we're going to then introduce a simple model that helps us to explain the results that we're going to show and help to clarify the mechanisms. All right, so here is a preview of the main findings. On the empirical front, we established three main findings. The first is that an increase in geopolitical risk increases the credit risk of the exposed banks. Second, US banks, they do reduce cross-border lending to the countries that's experiencing increased geopolitical risk, but their lending through their affiliates in these countries continues despite the rising credit risk that we find in the first step. And moreover, we find that banks do not adjust their foreign exposure similarly in this asymmetric way in response to other macro risks. And third, on the spillover effects, we find that in response to higher geopolitical risk, banks reduce C&I lending to US firms, and they also tighten lending standards in terms of domestic loans. And this effect mostly stem from geopolitical risk in countries where banks have these local operations. And in terms of model, we're going to show that these results can be explained by two key factors. One is the differences in funding structure between a local operation versus a cross operation, combined with some of the unique nature that comes with geopolitical risk, which you can think of as destruction in asset valuation that could come from, say, expropriation risk, physical destruction, profit repatriation frictions. And the key idea there is that foreign funding, which foreign affiliates receive, can limit the downside losses for the bank. So I'm going to go into detail about each of the components of analysis. So first, let me give an overview about how exposed are US banks to foreign economies. So the left chart here shows foreign exposure as a share of total assets of US banks. So about 20% of US banks' assets are foreign assets. These are the most internationally active banks that you probably are thinking about in your head. And the right side shows local exposures. So how much of that exposure come from the branches subsidiaries that these banks have in these foreign countries as a share of total exposures. And around half of banks' foreign exposures stem from assets in foreign branches and subsidiaries. And this is a more granular view where we take 4 active international banks, US banks, and look at the countries they are most exposed to over time. So 2010 on the left chart, 2019 on the right chart. And the key takeaway here is there's tons of heterogeneity in terms of how banks differ in terms of geography and magnitude of exposures across different countries, and this heterogeneity also changes over time. And with that in mind, we're going to construct a bank-specific geopolitical risk index, BGPR. And this BGPR at level of bank B time T is a weighted sum of the country-specific geopolitical risk index, CGPR. Okay? And the weight is using the exposure of a given bank to a given country by the overall assets of the bank. That includes the domestic assets. Okay? And we have various constructions. So the main baseline one is 4-quarter weighted average. We also use other variants for robustness. Now, the key question here is, what do we use for country-specific geopolitical risk index? So we use 2 sets of measures. One we view as kind of a more established one, as some of you may be familiar with, the one by Dario Cadara and Matteo Iacovello. And they construct a newspaper text-based method to construct this country-specific geopolitical risk index using the dictionary words that captures geopolitical risk. And so whenever you see a subscript N, that's a newspaper-based measure. And then we're going to supplement that with something that we construct, use firms' earnings call transcripts. So we're going to use the same dictionary as Cadara and Iacovello, and we're going to use the methods a la Hassan et al. To capture, which the measure captures firms' perception of geopolitical risk, and we average that up to the country level. And we mainly view as additional set of robustness to the main measures that we have. And it also allows us to kind of get deeper into different dimensions since we're aggregating from the firm. We can see which type of firm, as well as divide that into some words related to threat, some related to acts. So let's now look at these measures at the global level. So the left side are the geopolitical risk indices. The top one is the newspaper one, and the bottom is the one we construct. And at the global level, you can see the spikes are driven by major wars, Iraq War, Russian-Ukraine War, and the Israel-Hamas War. And on the right, we compare that with some of the more established risk measure that's known. The top right is the one by Hassan et al. Using the earnings call methodologies that we use for our measure, but just looking at economic uncertainty in general. And what's picked up there in terms of spike is global financial crisis, debt crisis, COVID. And the bottom right is the World Uncertainty Index by Nick Bloom and co-authors. And there also you can see what's driving some of the spikes are debt crisis, US fiscal cliff, and COVID. And we can also look at this at the country level. So this is just an example looking at Poland. The left panel are the geopolitical risk indices, and we see that the spike really came after Russian invasion of Ukraine. And the right are the various economic indices, including now the CDS spread on the bottom right. And there the spike is also the global financial crisis, European sovereign debt crisis. So from there you already see some distinct factors related to geopolitical risk relative to some of the other risks that we've been studying. So now with that, let's look into the empirical results. The first set of results is going to concern whether banks are accounting for the geopolitical risk on their balance sheet. So we measure credit risk based on the weighted probability default of these loans from the credit registry, the Y14 data. And we conduct this analysis both at the bank country level as well as at the bank level to see if the size is enough to even show up at a more aggregate level. And what we find is that banks, they indeed take that into account. They assign a significantly higher probability default to existing loans to countries that's experiencing an increase in geopolitical risk. And that effect is substantial enough to show up even at the bank level. And we also look at an event study focusing on pooled two events, looking at Russia's annexation of Crimea in 2013, as well as the invasion of Ukraine in 2022. And we see a huge spike in the credit risk that's assigned to loans that's exposed to Russia relative to all other loans on these banks' balance sheet after the shock. So the first takeaway from this set of results is that geopolitical risk increases US banks' credit risk. Now, how do banks respond given this increase in credit risk? Now we're looking at how their foreign exposures are affected by the geopolitical risk as measured by the country-specific geopolitical risk measure. And in particular, we divide this foreign exposure into the cross-border component and the local claims component. So the red results shows on the cross-border front, we indeed see that banks divest their exposures to countries that's increasing geopolitical risk. But surprisingly, on the local claims front, we do not see a significant response. And these set of results control for bank country fixed effects, as well as bank time fixed effects, as well as some macro controls that includes the stock prices, the exchange rate, and an indicator for whether there is a sanction imposed on the country. And now, do banks respond in this asymmetric way to other shocks, to other economic risks that we have traditionally been studying? So now we're kind of running the same regression, but with the other risk indices I showed earlier on the right-hand side. And we do not see this asymmetric response. So that suggests that there is something distinct about geopolitical risk here. So the finding two here is that banks continue to hold local claims in response to increase in geopolitical risk, while they do divest on the cross-border front, despite the increase in credit risk, unlike their response to other economic shocks. And third, we want to understand the implication for domestic spillovers. And for this, we're using the loan-level Y14Q data at the loan origination, with loan origination as the right-hand side variable. And we use the bank-specific geopolitical risk index that we construct on the right-hand side. So we control for various bank characteristics, loan controls, as well as firm time fixed effects. So this is looking at firms that is borrowing from multiple banks, controlling for potential demand responses by firms to geopolitical risk. And we're restricting our sample to just US firms. So this is really isolating kind of the domestic component, trying to understand whether there is spillover effects. So I'm going to show results at the loan level. We also have conducted at the bank level, and the results all hold. So this is the baseline table for the spillover effects, where we look at the loan origination on the bank-specific geopolitical risk indices. And we see a strong negative relationship. So an increase in bank-specific geopolitical risk as measured by our BGPR measure reduces the loan origination by these banks to US domestic firms. And the results are very consistent whether we add additional macro risks as our control variables, and also whether we use the newspaper-based measure or the earnings call-based measure. Then we proceed to ask, given the evidence that we showed about the asymmetric response of banks in terms of cross-border versus local to geopolitical risk, whether the risk is stemming from local claim exposures of these banks. So to that end, we decompose our bank-specific geopolitical risk measure into the exposure that's just coming from the local component versus the component that's coming from the cross-border element. So the first two columns, the result is purely looking at the BGPR stemming from the local exposures, and we see a strong negative relationship. Well, in column 3 and 4, we look just at the cross-border component, and we do not see a strong effect. And column 5 and 6, we combine both, and we see that even with that, the effect of BGPR on loan origination is significant when stemming from countries where banks have affiliates. So with these results, the third results that we establish is when geopolitical risk rises abroad, US global banks curtail domestic lending, particularly when they operate affiliates in these affected countries. And we have additional set of results looking at bank lending standards that's consistent with what I have shown on the loan origination front in terms of spillovers. So then we want to move to how do we think about the mechanism that's driving these results? So we construct a simple model, but we think that's helpful for illustrating and clarifying some of the key mechanisms that may be driving these results. So it's a 3-period model with one bank, and bank is endowed with equity, subject to a leverage constraint that's Basel III style, so perfectly mapping what the regulation exactly accounts for when they think about these leverage constraints for global banks. Banks decide how they want to allocate funds between domestic and foreign lending. So they could do domestic lending, which is 1 period, risk-free and variable, or they could do foreign lending. It's 2 period, uncertain, fixed in amount. And they could do this through 2 modes. It could be cross-border, in which case it will be funded by domestic deposits. So it will be US deposits that will be funding these type of lending. Or it could be through foreign local affiliates. Again, some fixed cost, but that part, it will be funded partially by foreign deposits. So these deposits that they could collect from the countries that they operate in. Now, foreign investment could be exposed to geopolitical risk. If a geopolitical event were to occur, the investment would yield no return. And the motivation there is we think about the loss of asset values that could result from an expropriation, asset seizures, or destruction. In which case, banks would not be obligated to repay the foreign depositors. So this is the most extreme case, but all the mechanism of the model would hold if we think of milder cases of such scenarios, as long as there's a sizable decline in return that could be come along with costly repatriation frictions, for example, that will prevent banks from repatriating profits home. So this is a picture of the basic idea of the model. In particular, I want to point out that in period 1 of the model, the banks learn about whether geopolitical risk is high or low. So state, good state or bad state. And they can make a decision about liquidation at that given point in time. Banks can liquidate their foreign investment, but subject to some cost. But if they were to liquidate, that will eliminate the risk of coming from geopolitical disruptions. So the continuation value of the local investment is higher than the cross-border investment because the liabilities will be defaulted in a bad or high geopolitical risk state. So as you can already see from here, the model predictions are aligned with the findings about geopolitical risk and foreign exposures. Banks are more likely to liquidate cross-border investment than local investment, and this gap becomes more pronounced as geopolitical risk increases. And there is an additional prediction here. Banks are less likely to liquidate local investment the more it is financed with local liabilities. And we test this prediction where we interact the country-specific geopolitical risk with local liabilities of these banks. So this is the same regression specification as the foreign exposure from the earlier slide. And as you can see, the interaction term on these country-specific geopolitical risk and local liabilities are positive and significant for the local claims, and insignificant for the cross-border. So this shows that banks indeed, they're withdrawing less from markets that's funded more by local liabilities. Now, we further solve the model to understand the relationship to domestic lending. And overall, the leverage constraint from there, you can already see there is a higher risk weight assigned to foreign loans. So the banks need to readjust their balance sheet elsewhere. So that will lead to a decline in domestic lending. So the model prediction on that front is also consistent with what we showed before about domestic spillover effects. So banks exposed to heightened geopolitical risk through foreign operations would reduce their domestic lending more. And the spillover effects will be larger when banks operate through affiliates because kind of the liquidation is less likely in these scenarios. And there's also some predictions about the spillover effects are larger for banks with lower capital ratios and profits, for which we also test using our data where we interact the bank-specific geopolitical risk index with the capital positions and profitability of the banks, and we find results that's consistent with the model predictions. So on here, I want to say a few words about some of the mechanisms we're thinking about. We think that one of the kind of a stark examples of geopolitical risk may be expropriation risk. And if we look back into history, geopolitical risk has heightened the likelihood of expropriation. We have seen various cases going back to 1917 with the Bolshevik Revolution through World War II, and more recently was Russia's invasion of Ukraine, where Western assets are seized under these scenarios. But of course, we don't have to go to this extreme state. Softer forms of state interventions can also lead to the same mechanisms. And we have done some work on this front where we've constructed an expropriation risk index at the country level, and we correlate that with our geopolitical risk index, and we see that the variation in these two indices are very much aligned, conditioning on country and time fixed effects. So let me conclude. Our papers established 3 findings on geopolitical risk and banks' foreign and domestic operations. We see that increase in geopolitical risk increases the credit risk, and banks respond by divesting from the cross-border front, but not as much from the local front, and that's unlike their response to other macro risks. And we see a significant spillover effects. And we think that foreign funding from these affiliates can partially offset the losses through a reduction in liabilities, so lowering kind of net losses, and that's maybe a key mechanism that's at play here. Thank you, and look forward to the discussion.
Thank you, Leslie. And the discussant is Veronica Di Falco. Hey, Veronica.
Thank you. Good morning, everybody, and thanks so much for the organizer for inviting me to this great conference and discuss this very interesting paper. So let me start by quickly summarizing the research question and the main findings of the authors. So the research question is broadly, how do these banks respond to increase in geopolitical risk? And the context in which the authors are studying this question is the US banks that have foreign exposure during this time span of 1986 to 2022. And the main findings are very simply summarized as follows. When geopolitical risk increases, somehow not surprising, cross-border lending goes down. Interestingly, the lending that happens through foreign affiliates instead remains quite stable. And more importantly, I think the result I actually like the best is the one about the domestic spillover lending, which I think it's very cool, and I think could be emphasized more in the paper, which is about the effect to the home economy, so the US, the economy and US borrowers. My overall assessment is that this is a very timely and nice executed paper. They have great data coming from supervisory balance sheet data of banks, and contributes to this new growing interest in the intersection of geopolitical risk and macro financial stability, but also more broadly to a very long-standing literature that has been studying what are the determinants of international capital flows. it is very important also for policy making, thinking about what kind of factors should we think about and observe when it comes to the international bank structure and the effects of the bank structure on potential spillovers. My comments are going to be mostly on this result that cross-border lending and local affiliates lending are different. And I'm going to talk a little bit about the identification of this, then about whether this is indeed some asymmetry that is specific to geopolitical risk. And then I'm going to conclude a bit with some thoughts about the paper, regulatory implications, and a bit the framing in the literature. So the first point I want to focus on is this test of whether the cross-border lending and the lending through affiliates are indeed different from a structural perspective. And one thing, of course, that comes to mind when you think about this research question is it is potentially an endogenous choice of the bank to choose whether to lend via cross-border or actually open up a subsidiary or a branch in a specific country. And so ideally, if you want to think about how is the lending changing given a geopolitical shock, you would like to kind of hold things, the bank and the borrower, and really compare how the cross-border lending and affiliate lending change one compared to the other. Now, there is a concern that indeed there could be sorting, the traditional kind of banking sorting issue of the bank might be sorting with different borrowers in different countries, and in particular also the way in which they lend might be endogenous to the type of borrower, say the industry, or the risk of the borrower. Now, there is a data limitation, so there's a certain amount of things that the authors can do and cannot, of course, do, given the data. Ideally, you will need to have a cross-country credit registry that also allows you to look at what is the type of lending and how is it done. Is it cross-border and is this affiliate lending? But so what are the authors doing? So they're doing a good job because they're already including a bunch of important fixed effects. So bank-by-country fixed effects allow you to sort of take care of whatever sorting that is static over time. And they're also including bank-by-time fixed effects that are going to allow to sort of compare borrowers within the same bank. But when it comes to this comparison of is the cross-border lending and the affiliate lending different, most of the regressions are using kind of a split sample approach that is comparing the two effects in separate kind of regressions estimation. And I think in this particular setting, this can be a little bit concerning because there is only a subset of banks that are actually choosing to operate through local lending. And so if you look also in the tables at the number of observations, the banks that are using local lending are very few. And so I wonder whether there is actually composition effects here that is driving potentially the comparison for which you're comparing sort of different sets of banks and country sorting. And so there are very small things that you can do to sort of attenuate this risk, which is estimate a pool regression with an interaction term rather than sample split, or restrict the sample to bank-country pairs that have both the cross-border and the local lending channel. Also, I think the paper could benefit from having a bit more summary statistics that allow us to sort of think about how are the banks and country exposure different and whether there is any sorting. The second point I want to raise is whether this asymmetry that it's found is really specific to geopolitical risk. And in particular to this idea in the paper, what is the mechanism? The mechanism is potentially, because of geopolitical risk, there's going to be expropriation risk. And the expropriation risk mechanism is corroborated by evidence that the reduction in lending is lower if the bank is using local deposits. So there is local funding. But, I mean, there's a long-standing literature on this topic. So, one of the papers that I'm picking on is a Schnabel paper that also shows that there is some similar asymmetry when it comes to transmission of liquidity shocks between cross-border and affiliate lending. And so I wonder how much this is really a specific feature of the geopolitical risk or a broader feature of the financial architecture of banking. And what the authors do is that they use other risk indices that Leslie has showed you to look at whether this asymmetry stands also by testing for different macroeconomic and financial indices. And I think what the authors could do to sort of provide more information about this is give us more comparison information between the geopolitical risk index that they're using and the other macro-financial risk indices, as well as kind of similarly to what I mentioned before, kind of hold the sample constant across these specifications, given that some of these risk indices might be available for certain countries in certain periods of time, but not for others. Lastly, kind of broader kind of picture points. As I said initially, I really like this point about the financial spillovers to the domestic economy, because this has broad implications for how we think about stress testing, what kind of factors should we look at, and macroprudential policy. And so one suggestion I have that I think would enhance the contribution of the paper is to quantify more the magnitudes of these spillover effects and also give us some examples of like major events that have produced major spillovers in the US economy and potentially minor events that instead had relatively lower impacts. Finally, I want to sort of bring the paper also a bit, the paper is very well set in the international banking literature framing, but I think the results are interesting and could be also be framed closely to the more international capital flow literature, and in particular, you know, these old frameworks of push and pull frameworks and the global financial cycle, and thinking a little bit about, I mean, these are my thoughts, but you know, in principle, you can think about geopolitical risk as a potential kind of push talk that it's changing the capital flows from the US economy to other emerging markets. And this asymmetric response across lending modes can sort of be potentially a structural kind of pool side component that can explain maybe the heterogeneity across international capital flows. Overall, my takeaway is that this is a very interesting paper and definitely a growing area of interest. I really like the point that these, we should pay attention to the international spillover effects of this. And I gave a few suggestions to sort of sharpen a bit the analysis and the contribution of the paper. But to conclude, a very important topic in the current global economy and geopolitical landscape. Thank you very much.
Thank you, Veronica. Leslie, would you like to take a few minutes to answer?
Well, thanks a lot, Veronica, for the thoughtful discussion. I really like a lot of your points. So let me just respond to a few. Yes, indeed, for the regressions for cross-border and local, I really like your suggestion about pulling the regression together. In fact, we have done that. And I know we do find that there is much stronger response in terms of cross-border relative to local when we pull everything together and add an indicator for the specific mode type in our regressions. And I think showing both set of results helps with that. And what adds to our confidence about these set of results is if we looked into earnings call transcripts of these banks, and there are statements which we cite in our paper are illustrating how banks are really thinking about these decisions and how they're thinking about the segmentation in terms of kind of the cross-border component and local components. For example, you read some of these large global banks after the Russian-Ukraine invasion, and you can see, that they are really explicitly talking about how, a lot of the exposures through their local affiliates may be thought of as kind of an isolated component, and where there are downside losses are kind of sheltered by the deposits or funding they're getting from these fronts. So that adds to our confidence about how we're thinking about these results. And I love your suggestion about the quantification. We actually also, that's going to definitely be incorporated in the next iteration of the table. We also have done that, and that's a very nice suggestion. And one final point I want to clarify is in terms of the Schnabel paper that you point out. So for that paper, they're looking at using Peruvian credit history data, looking at how US banks are lending to Peruvian banks versus US banks with operations in Peru differently in response to liquidity shocks. So the key thing they're highlighting is kind of following this idea of internal capital markets by Cettarelli and Goldberg, and how there's more internal capital markets working through within the banking organization in response to these shocks. So that is something I think is a bit distinct from what we're doing. So we looked at the internal capital markets components, and we do not see a significant difference effect in response to geopolitical risk. So less connection between kind of the home and affiliate in response to the geopolitical risk scenario. But thanks for raising that.
Thank you. All right, so I'm going to start here and then.
Thank you. Carolina Villegas, de NECB. Very interesting paper. I was wondering whether you have information on the borrower side in the target country, in the end country, because there is this all the literature looking at FDI, banking in FDI that would accompany like firms. And I was thinking that maybe you could use that to try to distinguish your like seizing like channel. So whether it's like these subsidiaries, these affiliates like lending to multinationals that now like are going also into trouble because of the geopolitical risk. And if you could distinguish like on the borrower side, like what these affiliates are doing, I think that would be like a nice exercise. Thank you.
Take a second question. Yeah.
Cosette, ECB. Thank you very much. It's a very interesting paper. I have a somewhat technical points on the spillover effects. So banks that are more exposed to geopolitical risk could be providing specialized loans, for example, to support exports. I have in mind, for example, the Paravicini Rapport Tensionable paper that goes in this direction. But then the effects could come from a differential demand for credit by firms that, for example, export to Russia. And in this case, then, so if the banks that are more exposed provide specific type of loans, then the effects could actually come from a demand effect. And I have in mind technically a violation of the Kwajalein assumption that firms are indifferent across banks. Maybe you could look at specific loans and check whether there is an effect. And if there is time, I didn't get about the, so you pushed a lot the risk of expropriation, but I wonder whether part of the increase in the risk of borrowers' default comes from the effects that were shown by the previous paper by Beata. So, for example, there could be an impact of sanctions, of secondary sanctions, and also reputational risk.
It was technically 3 questions, so.
So I think the first 2 questions I think are related, and we would love to look at the demand side at a more granular level. As Veronica alluded to, we would need kind of a cross-country credit registry in order to get to that dimension of looking at who are the exact borrowers of the US affiliates in these countries. So in one data set where we used to look at cross-border versus local, unfortunately we only have at the more area level. At the Y14, we can see the borrowers, but we cannot distinguish whether it's a subsidiary branch versus a home country. So we're kind of, our hands a bit tied on these fronts. With that being said, I think, no, even with the demand side being front, I think the evidence that we dug into on the various disclosure reports, earnings call transcripts, analysis about how banks are talking about the segmentation of the market and how the local ones are kind of thought of and funded and operated differently relative to the home in response to kind of what they explicitly say, an unexpected turn of events in the Russia case, gave us some confidence there is kind of a supply effect margin happening at the same time.
Yeah.
Sorry, the second question, sorry, could you remind me?
Yeah, I was wondering whether the increased risk of borrowers' default may be coming also from the impact of sanctions and reputational risk, and that was actually the object of the previous paper.
So I think we control for sanctions in terms of the cross-country relationships in our specifications. And I think now the key aspect we want to emphasize is kind of the differences in funding structures across the cross-border and local components, whereas these funding structures are providing some differences in terms of sheltering effect. There could be expropriation risk, there could be other types of risks, disruption, destruction that could come with geopolitical risk that affects changes.
And we have 2 questions, Arisa and Beata. Oh, 3 questions, sorry.
Hi, Larissa Schäfer again from Frank Wisconsin ECB. I very much like this paper. I've read it actually already before. I have sort of 2 interrelated questions. So one is related sort of to the story, also what Veronica alluded to, I think, and also Enrico. I think it's very hard to pin down this expropriation channel because overall, I find the result sort of a positive result maybe for global banking, because typically in the literature you see when there's a shock, foreign banks actually take out their money and lend more domestically, and you find actually the opposite, that somehow they continue to lend in local markets, which could allude to the fact that they're actually following the exporters and continue sort of locally having a local knowledge to lend with the multinationals, which I know you cannot look at. But I was wondering maybe at least what you could look at is maybe pricing, that it pays off for them to continue to go through this local market, and they sort of risk of taking sort of cutting lending in US, so it must pay off for them to do that somehow, right? So because I mean cutting lending in US just because of some small countries, I mean you know probably which countries there are, is a big thing, right? So, I mean, that must change sort of the profitability of the banks a lot, so it must be profitable to stay there somehow. Thanks.
Beata?
What is geopolitical risk, right? You talk about expropriation, but then you have shown us a spike in the index for Poland. So essentially, what you have in mind is Poland being invaded by Russia and expropriation happening. But could you really distinguish it from the energy shock that took place in Europe as a result of the war and affected Poland directly as well as indirectly through its links to the German economy, which went into deep recession? And second, you gave us example of JP Morgan Chase and other US entities being expropriated in Russia, but Raiffeisen Bank has been profitably operating in Russia. So is geopolitical risk a bilateral variable?
And last but not least, Katerina.
I have a very important question. Is it thank you very much for the very interesting presentation. Now, in the recent years, we have learned a lot about how banks react to uncertainty, and I can think of a few very good papers about this. But you showed us that your results do not hold if you look at other type of uncertainty measures or risk measures. And going back to Beata's point, what is that makes the difference here? What is the channel such that makes banks react differently to, for instance, uncertainty shocks or risk shocks in these foreign countries, which also have the potential to increase credit risk for banks? So maybe if you can share some more insights on what are the channels that explain this difference. Thank you.
And in the negative time that we have, please do provide some answer.
I'll be very brief. So I think some of the points are very much related in terms of the ex post effect, and I think that will be interesting to look into. So there is kind of the ex ante thinking about how banks are responding, then the realization in the long run about how things evolve, which they may not fully anticipate from the ex ante perspective, but I think it will be interesting to look at. And I very much like that point. And on the about what is unique about geopolitical risk, so we think of it as, it encompasses some uncertainty risk. For example, some of our components of how we construct geopolitical risk is kind of the uncertainty factors that's come in with geopolitical, but there is also kind of the physical destruction component that could come. So it's kind of some broader uncertainty, but something that's very unique to geopolitical risk as well. And so some of kind of the cases or the examples that I was thinking about in terms of extreme uncertainty, expropriation risk, asset seizures, repatriation, limits to repatriating profits, are something that are more likely to come in like geopolitical risk disruptions relative to just kind of economic crisis. And that is kind of what motivates to write down our model. So there's something here that's more than kind of just general economic uncertainty, which banks likely is more equipped to manage given their risk management function that's already operating at these banks. And so in terms of Poland, we agree that there is not kind of a expropriation likelihood isn't very high for some of these countries, but there is maybe like second order effects happening to that front in terms of indirect exposures, given that they are some more Russian related operations in these countries, as well as kind of the softer forms of interventions that I mentioned about some kind of limits to asset repatriation that could happen, which we've seen in cases of past crises. But I'm happy to chat more about that.
Yeah, not sure about the Russian-related operations there. Okay, thank you very much for this great session, and I think we have a break. Welcome back. So we're moving from a very important topic, geopolitical risk, to another equally relevant topic, which is heterogeneity in the economy, particularly across households. We have today here, I'm Fiorella De Fiore, I'm research advisor at the BIS, and we have Antonella Trigari from Bocconi University, Anna Rogantini-Pico from the ECB, Christina Molnar from Norwegian School of Economics, and Morgana Richard from Sciences Po. So the first paper will be presented by Antonella. The floor is yours.
Thank you, Fiorella. Okay. This here is better. Okay, good. So thanks a lot for the invitation. Thanks for being here. It's a pleasure to be again at this conference. I really enjoy the atmosphere, and I think it's really an important initiative. So first of all, let me say that this is very much work in progress. So I look forward to your comments, and I should also apologize and thank in advance before seeing the discussion to my discussant, because she had to work on slides, and I'm not sure whether to call it a draft, but some very preliminary draft. Okay, so this is going to be a paper about fiscal policy, aggregate demand, and with a focus on labor reallocation. So let me tell you what is our starting point, or was our starting point, even if we're changing a little bit the focus as we learn while working on the paper. So the first fact is that economies are characterized by substantial labor reallocation across sectors. And what we mean by labor reallocation is reallocation of job seekers, so unemployed workers who move across sectors, so substantial search mobility. The second fact is that sectors are quite heterogeneous in several important dimensions. The first one is their labor market outcomes and conditions, and in particular unemployment risk, and the associated and the extent actually of insurance against this associated risk. At the same time, sectors are also different in terms of their exposure and influence on other sectors in the aggregate economy, because they differ in terms of the incidence of shocks and in their position in demand and production networks. So as a result of these two facts, it's going to be the case that shocks and policies are going to have heterogeneous effect across sectors. These heterogeneous effects are going to be transmitted and propagated through sectoral linkages of various types. And importantly, I say importantly because this is the focus of this paper, these effects are going to be mediated by reallocation of workers across sectors. Now, I'll tell you now what we do or what we plan to do in certain dimensions, and I'll dig a little bit deeper on why we do it. So we first document in the United States, across the last 2 decades, labor reallocation and sectoral heterogeneity across a number of dimensions, and in particular to document extent and cyclicality of labor reallocation, we are going to construct some new indices of gross labor reallocation. We then, and this is ongoing work, estimate the impact of countercyclical fiscal policy. In particular, think about unemployment insurance extensions during the Great Recession or COVID, or firm subsidies, for example, PPP, the Paycheck Protection Program during COVID, on labor reallocation, as well as on aggregate unemployment, both directly and through reallocation. We develop a multi-sector new Keynesian model with heterogeneous agents, so incomplete markets and idiosyncratic risk, the hand component, search and matching frictions, the sum component, which is going to importantly render unemployment risk endogenous, an input-output network we will have sectoral heterogeneity across all these dimensions, plus we will allow for endogenous reallocation of job seekers across sectors. We then and this is, to our knowledge, this is the first model that combines this element into a tractable, and that's very important, framework. We then calibrate the model to US data, and we use the model to study the effect of countercyclical fiscal policy on reallocation and employment, and to connect the results we get from the model through counterfactuals to the model predictions, to the empirical estimates that are actually in progress. Okay, so why we do it? So the first reason why we do it is to address recent changes in the nature of shocks and the associated policy responses. Economists have experienced, and this has been emerging in this conference quite importantly, an increasing prevalence of asymmetric shocks. So sectoral shocks, think about pandemic, trade, energy, climate, artificial intelligence. Now, these shocks are going to cause uneven labor displacement across sectors, and this is going to make labor reallocation a central adjustment mechanism. In particular, this is going to depend also on the persistence of the shock. Now, yet, the counter-cyclical policy responses, they are rarely conditioned on sectoral heterogeneity or the incidence of the shocks. If you think about monetary policy, it remains largely untargeted. And fiscal policy, and here I'm thinking a little bit about the US versus Euro area debate after COVID, they're mostly focusing on whether they should target households with transfer or firms with subsidies. Now, the second reason why we do this exercise, and in particular we build this model, is that we want to study how labor reallocation shapes the transmission of shocks and the effectiveness of policy. And to do that, we want to capture, so here I'm going to justify the Hank sum and the Hank IO part of the model. We want to capture two key mechanisms of amplifications that are associated to aggregate demand effects, and that are at the same time going to interact with labor reallocation. The first one is a feedback loop that emerges in Hank sum framework between aggregate demand and endogenous unemployment risk. So the idea is that if a shock causes an increase in unemployment risk, then this is going to prompt higher precautionary savings motives. This is going to reduce aggregate demand, consumptions and aggregate demand, and in presence of nominal frictions, this is going to cause firms to respond in this setup by posting fewer vacancies, and this behavior is going to further increase unemployment risk through a feedback loop that amplify the initial effect of the shock. Now, this mechanism is going to interact with reallocation through a number of channels, and here I'm pointing to two important channels that are related to this paper. One is a compositional channel and one is a within sector channel, because as workers move in response to a sectoral shock, from the heat sector, say, to other sector not hit directly by the shock, then there are going to be compositional effects associated to the fact that these sectors are heterogeneous, and in particular, some sector might provide better insurance than other sectors to unemployment risk. At the same time, there are going to be within sector effect, because this reallocation is going to change conditions within sectors. It's going to change, for example, is going to reduce the unemployment risk in those sectors that are seeing workers leave, and it's going to because the job finding rates of the remaining workers are going to increase, and it's going to increase risk in the receiving sectors. The second aggregate demand amplification mechanism that we want to have in the model is the Hank AO part. Here, the amplification arises from the interaction between aggregate demand and the IO component. The idea being that a sectoral shocks that causes, say, a reduction in demand in a given sector is going to cause a cascade of effects, because every good uses other goods as intermediate inputs, and so demand is going to be diminished in other sectors that at the same time use the final output of the original sectors through a cascade of amplification effect. And here, in the interest of time, but also because for now we focus more on the other mechanism, I'm going to skip a detailed description, but again, we have compositional effects and within sector effects that are going to be associated with reallocation. So I'm going to skip the related literature, except that I want to emphasize how we relate to the first strand of the literature, which is about sectoral shock and reallocation. So this literature has emerged from the seminal work of Lillian, 1982, where the idea was that economists have some desired reallocation because they are subject to idiosyncratic structural sectoral shocks that imply that factors, capital and labor, should move across sectors. Now, because there are frictions, this movement is time-consuming and costly. In particular, this movement is going to cause unemployment because it takes time for this worker to move. So reallocation causes unemployment. Here, instead of focusing, the focus is very different, because instead of focusing on desired reallocation, we focus on the role of realized reallocation. So the idea is to try to understand how realized reallocation, actual movement of workers across sectors, is going to mediate the effect of shocks. Okay, so I'll briefly show you some evidence, a sketch of the model, and then an application to unemployment insurance. Okay, so first of all, what we do, we use CPS longitudinally linked data to measure what we call realized reallocation. So basically, we have data on new hires across sectors, and we also have data on the last sector of employment before the unemployment spell. So, and here you see these are the sector of last employment, and here are the sectors where workers find jobs. And we estimate substantial reallocation because on average, 48% of job finders find a job in a sector that is different from their previous one. We also consider a different type of reallocation of job seekers. So this is trying to understand how job seekers change their sector of search, which is obviously not observed. We don't have this information in standard data set. We don't see something as sectoral unemployment. So what we do, we propose a new method that is going to use both data and model. So we build a dynamic equation, a recursive equation for the stock of searchers in each sectors, and which is going to depend on the inflows and the outflows, and then we use available data together with estimated job finding rates by sector to estimate this probability that a worker who was searching in transportation and utility in a given month is searching in the same sector, or instead is searching in a different sectors. And also, according to this measure, we find that there is substantial reallocation. 32% of job seekers switch sectors, switch the sectors in which they search each month. Now, we then want to make sure that this reallocation has some cyclical component, as otherwise our question would not be interesting. So we look at the evolution of these of two indexes that are based on these matrices, and we find that they are quite cyclical. In particular, they decline during major recessions. This is true for the realized reallocation and for the search-based reallocation. So finally and briefly, we look at heterogeneity in terms of unemployment risk and consumption insurance. So here you see a scatter plot where you have the unemployment rate, and we use both last employment before the unemployment spiral and the search-based unemployment measure. And on the vertical axis, you have the consumption ratio, which is our measure of consumption insurance. So the ratio of consumption of unemployed workers to employed workers across sectors. And so what's the message from this figure is that there is substantial heterogeneity, but also that there is a negative correlation among these two characteristics, so which implies that sectors that are more exposed to unemployment risk, they're also going to be less insured against it. Okay, so the model so let me switch to the model. So the model builds on some previous work I have, and I forgot to mention my co-author at the very beginning, I think, so Alexei Gorn and Niccolò Rizzotti. So the starting point is a tractable Hank-Sem model, where basically what we do through some household structure and intra-period borrowing with employment-specific liquidity constraint, we allow for incomplete markets and idiosyncratic risk. Importantly, idiosyncratic risk is endogenous, leading to this amplification loop that I was mentioning. To this baseline setup, what do we add? We add multiple ex-ante heterogeneous sectors, input-output linkages, and sector reallocation, where through a family construct, we are going to, the model is going to imply gross reallocation across sectors. So to do that, of course, we need to introduce some randomness, because workers are going to move to, because that's what we observe in the data. When we look at gross flow, we see that workers move between sectors even when the value of searching in that sector might be the same or even lower. So we introduce some randomness, as in the trade literature, through taste shocks. So basically, this is the structure of the Hank-Sem model. And so we have a labor market that is characterized by search and matching frictions, where household and firms are going to interact. Households are going to be characterized by incomplete markets, consumption inequality in a tractable way. And then we have firms, and so what I should emphasize, we have three types of firms. So basically, if you think about the well-known New Keynesian Dixit-Stiglitz type of structure, we have an additional layer. Why we do have this additional layer? These wholesale firms that post vacancies, because we want to separate the price-setting decisions to the vacancy posting decision for tractability reason. This is something that has been done since the literature has been doing this. And finally, we have a government that sets counter-cyclical policy, fiscal policy. Now, here that's our setup. So to the Hank-Sem, we have so first of all, we have multi-sectors, sector I and sector J. Why these are important? Because they are ex-ante heterogeneous. And second, because they define local labor markets. So they define where workers and firms are searching. And how are these sectors linked? They are linked, first of all, through labor reallocations. So workers who are unemployed, they are going to move across sectors. And they are also linked to an IO, network. And in particular, you see here that the retailers, who in the one sector model, they only buy, they only use output from wholesale firms, which basically is labor. We should think of this as labor. Now, retailers are going also to use intermediate inputs, so they use a bundle of intermediate inputs, and so these generate the links. And we also have, of course, households who consumes a bundle of final goods. This is, in this kind of work, this is one key slide, but I'm going to skip it in the interest of time, and just mentioning that we use sectoral labor market stock and flows, household and firm level sectoral targets to calibrate the model. And in particular, we need to calibrate moving costs across sectors, and we do it by using the search-based reallocation matrix, and we estimate the costs of moving across sectors that are consistent with the observed flows. So how much time do we have? Perfect. So here that's the last part of the paper in the current form. So we try to see what the model says about how reallocation is going to shape the transmission of shocks first, and then the effects of countercyclical policy. And in particular, we think about unemployment insurance policy. So let me just describe the exercise that we are going to implement. So first of all, we're going to consider sector-specific separation shocks. And the reason we focus on this is that this is a shock that is a very natural interpretation in our framework because it directly affects one key margin, which is unemployment risk, that is going to be interacting with aggregate demand and with reallocation. We calibrate the sector-specific shock to generate a 1% increase in aggregate unemployment because we want to abstract, at least at this stage of the analysis, from differential incidence of the shock. And we're going to focus to think about the effect on the response of unemployment, and both the aggregate unemployment and the sector-specific unemployment rates. We will look at countercyclical UI policy, and for now, we have an untargeted policy. So this is going to be countercyclical UI policies that is homogeneous across sectors. In ongoing work, we are thinking about targeted policies of different types. And we look at 3 sectors economies, so 2 are ad hoc economies, so we start we want to provide a benchmark, so we have a symmetric economy, so we calibrate 3 sectors to the aggregate economy, and we assume a symmetric input-output network. Then what we do, we just introduce one dimension of heterogeneity, which is going to be consumption insurance. So one sector, sector 2, is going to either have lower or higher consumption insurance. And you might ask why you should consider lower and higher. Isn't this symmetric? No, this is not going to be symmetric because one insight that we derive from this preliminary analysis is that actually the direction of reallocation is going to be key. So what kind of sector are shedding workers and what kind of sectors are actually receiving workers. And finally, we check that the results also hold in a fully calibrated economy. We have 10 sectors, but here to sort of make the results a little bit more salient, we pull together similar sectors, and we have a 3-sector calibration with goods producing, low-skilled services, and high-skilled services. Okay, so here it's the case of symmetric sectors. On the first plot, you see the response of aggregate unemployment to a separation, so there is higher separation in sector 2. And here you see the sectoral responses in terms of unemployment rate. So these are the unemployment rate of the 3 sectors in different colors. And it's always going to be the case in this exercise, so let's remind it that the solid line denotes the case where we allow for reallocation, while the dashed line is the case where we don't allow for reallocation, so that we can see the effect of reallocation. So the first message is that there is propagation. Of course, because we have an input-output network and we have also demand linkages. So even in the case of no reallocation, the dashed line, you see that the sectors that are not hit directly are going to see an increase in their unemployment rate. Second, and now let's compare the dashed line to the solid line in this second plot, reallocation is going to lower the dispersion of unemployment, which is intuitive, right? As some workers are going to move from the hit sector to the not hit sector. However, we don't see any effects of reallocation on the aggregate unemployment rate. Why is this the case? This is because of symmetry. That's why this is our benchmark. So workers are moving across identical sectors, so there is no effect from composition. But at the same time, the within sector effect, so changing in conditions within sectors are going to be there, but they're going to be exactly offsetting each other. Now, we then look at policy, and okay, I'll take 30 seconds more. We then look at counter-cyclical policy, and here you see the effect on aggregate unemployment. So the message is policy is counter-cyclical. That's not obvious in our model because we have both positive aggregate demand, stabilizing aggregate demand effect, and destabilizing distortionary labor market effects. But the effect of the policy, when you compare the no-reallocation to the reallocation case, they are exactly the same. So policy doesn't make anything to the effectiveness, reallocation doesn't make anything to the effectiveness of fiscal policy. Now, we move, and then these are the last two slides I want to show, we move to the asymmetric case. So first of all, here reallocation is going to have an effect, and in particular, reallocation is going to be stabilizing. And the reason why reallocation is stabilizing in this case, it's a very important reason, is that the heat shock is the shock with lower consumption insurance. So basically, as workers move from low insurance sectors to high insurance sector, there are going to be positive aggregate demand effect associated to this reallocation coming from both compositional effect and within sector effect. Now, what about policies? How does policy interact with reallocation? And here the results is a little bit surprising. So even though the highest stabilization emerges when you have both policy and reallocation, actually reallocation is going to dampen the effectiveness of policy. And the reason is that policy is going to have differential effect across sectors because it's going to be more valuable in the low insurance sectors. And because of this differential effect, policy is going to dampen reallocation, and by dampening reallocation is also going to reduce the positive effect that comes with reallocation. And finally, we confirm our results in the calibrated three sectors economy. So this is a list of what's next, but in the interest of time, I'm going to leave the floor to Anna. Let me take the glass so that you don't take my glass.
Thank you. The discussant is Anna Argantini Pico from the ECB. Thank you.
So thanks a lot for having organized yet another We Are In conference. I've been participating since the very first online edition, and I think it's really an amazing opportunity for youngish economists like me. So thanks again for inviting me to discuss Antonello's paper. Let me first tell you why you should read this paper once there is a first draft. Could I get the, no, it's here, the clicker. Okay, sorry. So this is a super quick review of the last 5 years. So in 2020, we were hit by COVID pandemic. Then the war in Ukraine broke out, and we had an energy price shock to face. Then the second term of Trump came, and now we are, as we've been talking a lot earlier on, we've been dealing with trade wars, tariffs, and sanctions. Underlying this, we are facing climate change for already now some time, and this is something that is here to stay, if not getting worse. And then yesterday, we also discussed quite a lot about AI. We're at the beginning of a revolution. So why did I go through this? To just quickly illustrate the complex world we are living in, and the fact that like our economies are really hit by shocks which have very different natures. Some are health, political, energy, so very different nature. They have a very different incidence in our economies and across sectors. And they hit sectors which are heterogeneous to begin with. On top, we are trying to craft policies to face these shocks. And these policies often are not targeted to specific sectors. Like, for example, the many fiscal packages were maybe targeting some groups of households or firms, but not really one sector or the other. Or more generally, like monetary policy, they're targeting aggregates rather than specific sectors. So why you should read Antonella's paper and her co-authors, of course. It provides a very comprehensive but still tractable model. It seems an oxymoron, but it's not in their case. They manage to really have the main features that allow them to quantify all the layers of heterogeneity, in particular to look at the propagation of shocks and the efficacy of policies. So what are these main ingredients that they retain to study this propagation? So the first channel is a hang sum, so heterogeneous agent, Neo-Keynesian model, so with price rigidities, and with frictional labor markets. And this gives rise to a feedback loop between aggregate demand and unemployment risk. So you have a shock hitting a sector, unemployment risk goes up. Because there are heterogeneous agents, they engage in precautionary saving, and so they save more, consume less, demand drops, and unemployment risk goes up, and you have like firms post less vacancies, and so you have this feedback loop. So this is captured by the hang sum part. On top, there is another channel which is coming from the hang input-output, so network structure on the production side. And this also generates an additional feedback loop between aggregate demand and the network structure. Of course, the strength is going to depend on the centrality of the firm sector hit in the network. But in any case, there is this propagation effect. The third channel is coming from labor allocation, which is really the focus of the paper. So on top of the other two, you have labor reallocation, which interacts with the aggregate demand mechanism that I just mentioned. And this labor reallocation, what is interesting is that it can either amplify or dampen the effects of the shocks and policies, depending on the direction in which this reallocation happens. So this is very interesting. And just to recap the main quantitative results so far are the following. So when you have a sector-specific separation shock, what happens with labor allocation? Labor allocation is going to be stabilizing unemployment if it hits a sector that has low consumption insurance. Why? Because people are going to move out of that sector into a high consumption insurance sector, and so this lowers unemployment. Instead, it amplifies unemployment if it hits a sector with high consumption insurance, because then people like move towards a low consumption insurance, and so their unemployment goes up. A similar asymmetry happens because of policies. So it's not just shock propagation, but also how policies interact with the shock. And in particular, Antonella has talked about unemployment insurance extensions. These are less stabilizing if they hit a sector with low consumption insurance, because people stick around more in that sector, and so the benefits of reallocating labor to another sector go down, and on the contrary, it's more stabilizing if the shock hits a sector with high consumption insurance. Okay, so to recap, both there is a change in the composition of employment and the consumption across sectors, which is going to alter aggregate demand and propagation of shocks. So now I have three main thoughts. The first concerns the concept of labor reallocation. In the paper, they have a very clever way to construct this search-based reallocation index, because in the data we don't see really where people search, job seeker search. We only see the job finding rate and the job separation. So they estimate this first, they sector-specific job finding rate, and then they use a recursive equation to describe how job seekers move, the stock of job seekers move from one sector to the other. So what I was thinking is that this could be extended. So at the moment, I assume that searchers only search in one sector, but I think that it's more like if I have a given skill, I search in all sectors where there is my occupation. So I would allow for this margin, so to search in multiple sectors at the same time, and maybe the dynamics would change. Secondly, there is another very important margin that has emerged from the literature, which is the on-the-job search. So there are flows going from employment to employment, not just from unemployment to employment. And I think that especially given that the focus is really on labor reallocation, it would be really interesting to also incorporate on-the-job searchers and not just focusing on unemployment. Thirdly, now they really focus on heterogeneity across sectors, but there could be heterogeneity across skill, which is also relevant, and people trying to move from one type of skill to another, especially if we think of shocks like AI, where some type of occupation can be really kicked out in a sense. So I think this could be another additional margin to look at, so heterogeneity across skills. The second comment that I have is on the type of shock that they look at. So in the motivation, we bunch together different types of shocks. Some are more cyclical, like COVID, that has persistent effects, but it was more like cyclical, and others are more structural, like the AI revolution or climate change. And at the moment, the analysis really catered towards the more cyclical shocks. So they look at a temporary separation in one, like an increase in the separation rate in one sector. But I think that the model is very encompassing, and because of the structure that they have, they could speak towards more structural shocks as well. In particular, for example, if I think of the AI revolution, they could consider shutting down of a whole sector, or really a change in the input-output structure, and how this would affect the reallocation and the propagation of shocks. And my third and last comment is which policies they're looking at, but Antonella have already mentioned that, so now they're looking at untargeted unemployment insurance extensions, but of course it would be interesting to look at targeted policies to a specific sector. And in addition to that, not just looking at what type of agents, not just policies targeted to sectors, but to also different agents, like firms versus workers, or really looking at matches, like policies that retain the match between employer and employee. And finally, but this might be maybe the next paper, would be to look at a more normative side, because of course now they're trying to gauge quantitatively the effects of policies and shocks looking at past shocks and running counterfactuals, but precisely because labor reallocation and policies might either dampen or amplify the effect of the shocks. I think thinking of what would be the optimal policy could be really interesting. So it's a very ambitious project, still a tractable model, and they look at how reallocation mediates the propagation of shocks and policy role. Okay, thank you.
Would you like to respond?
Yes.
So thanks, Anna, for this very nice discussion. I'll borrow all of your suggestions, but some of your slides as well, because they are very nice. So let me answer in a little bit in random order. So in terms of the policy, yes, that's exactly what we want to think of. Targeted policy, firms versus sector. Hiring, subsidy, job retention scheme, this is really important if you want to address the European response, job retention schemes to COVID versus, ensuring versus the unemployment extension response in the United States. This should we insure the job or should we insure the worker? There is a technical aspect that we need to have endogenous separation if we want to think about job retention schemes. So it's a little bit easier to think about the hiring incentives then. Now, in terms, so I think this point of on-the-job search is actually, that's another, extension which might be demanding technically, but it's really important because, so why we focus on unemployment searchers? Because there are a lot of new eyes from other jobs. I myself have worked on that. So the job ladder is really important. But the idea is that it's uncontroversial that unemployment risk is important for aggregate demand, and that policies actually, many fiscal policies, that's what they target, right? Unemployment. But there is a literature, and it's an emerging literature, and I have two students, actually, PhD students working on that, that they argue that idiosyncratic risk also comes from moving up the ladder. So the risk that this ladder is going to weaken or is going to break, in a cyclical manner during recession is a risk that should be incorporated, and it's going to interact with aggregate demand. And actually, there are no policies that address that risk that is emerging as an important margin. Now, in terms of occupation,
if you want to keep some time.
Very quickly, in terms of occupation versus sectors, yes, I'll be super quick. It's really important. We are working on this. So what is a local labor market? It's occupation, it's sectors, it's the interaction of the two. And so we are working hard on this. The type of shocks, I think one benefit of this framework is that we can actually think of supply and demand shocks. In terms of supply shock, so the focus is on demand, but basically if, all the more structural shock that you have mentioned would still have a transitional period and would generate a recession, then we would have something to say about that and how reallocation would shape this, whether we would want quick or a more rapid, a more gradual reallocation to get to the new steady state. Thanks a lot.
Thank you. So we have a few minutes for questions. Beatriz?
Beatriz González from Banco de España. So thank you very much. It was super interesting. So I wanted to ask about the hang part of the model, because you talked a lot about fiscal policy, but you have this side with nominal rigidities, with monetary policy that you're not looking at. And I think it's very interesting. First, why do we need this hang part? So you explained that it gives like this extra feedback loop, but what would we be missing if we don't have that part? I think this would be super interesting to compare this to the flex price economy and having these price rigidities. And also having this, I mean, I don't know if for this project or another one, I would be very interested in seeing what are maybe the side effects of monetary policy now that you have here, no? So we know that monetary policy is not intended for this side, but it might have effects through all these channels that you're exploring in this paper. So I think it would be something super interesting to understand. Thank you.
Thank you, thank you. Should I?
Any other, maybe we collect the questions and then
Let me write it.
So, Carolina Villegas, two very small points. So I thought that maybe like a cross-validation of the nice exercise that you do with this new way of the labor reallocation might be to look at job postings, that there are like big data sets that allow you to basically classify like job postings by sector. And the other thing that I thought is in this literature of like I/O and networks, I mean the centrality, right, and maybe connected to Anna's point, like the type of shock connected to the centrality of the sector in the economy. So that might have like bigger effect on propagation.
maybe if you can add very quickly, you quickly mentioned at the end that there's a possibility to look into demand and supply shocks, which I think would be very interesting. My intuition is that the supply shock could actually transmit more through the input-output structure of the model and perhaps mitigate a bit the benefits of labor reallocation, because you would also have the increase in prices coming through the input-output structure.
Yeah, no, absolutely, and this relates also to Beatrice's question. I mean, this nominal rigidity, whether it's price or wages, are needed because of, otherwise aggregate demand would not have real effects. But it's really important. I mean, and actually, the input-output network has focused very much on transmission across heterogeneous sectors. In that dimension, how different nominal rigidities across sectors. That's a very old. Actually, the multi-sector non-IO type of literature was very much focusing on that, and yeah. So both shocks, supply and demand, will. It's true. They will first act. I agree, but then this demand effect will kick out in both cases, but the interaction will be different. And thanks for the, we haven't thought about using, but there is, the firm part hasn't been explored too much, but yeah, once we get to that, I think using job posting is going to be, and also the, looking at the correlation between type of shocks and position.
And we needed to move to the next paper. Thanks so much for a very interesting presentation and discussion. And this is about Hankson.
First, thanks for the organizers for having me here. This is a fantastic conference. I'm Kristina Molnár. This is joint work with Florino Bibia, Refet Gürkaynak, who's sitting at the back, and my fantastic colleagues from Norway, Mattis Mellum and Sigurd Gallasen, from whom I learned a lot how to work with Norwegian administrative data. The title comes from the Hank literature, so we are speaking to the kind of models that Antonella is working with. I lost the microphone. And what we're doing is we're providing sufficient statistics out of Norway. That's the Son part. That's why it's Hankson. So we macroeconomists, we are interested in the aggregate. But how do we aggregate and how do we write models for the aggregate? That's not such a trivial issue that has been on the table since the beginning of macroeconomics. We have a relatively good idea of how, for example, individuals choose consumption linked to their disposable income. That's what I have here. Oops, here. But can we write the same thing in the aggregate? That's not that trivial. There can be all sorts of issues. First, the consumption function doesn't have a closed form solution, right, typically. There can be non-linearities. How do we aggregate them? People can be heterogeneous. So for a while, the literature focused a lot on mainly the mathematical part of this. What are the conditions under which we can aggregate and then write a representative agent economy? In the recent macro literature, in the Hank literature, they have a very different approach. And they say, well, instead of aggregating upfront and writing down a representative agent, let's embrace heterogeneity and aggregate ex post after optimal choices have been made. But still the question remains what types of heterogeneity we should focus on. What are the relevant dimensions of heterogeneity that we should focus on? And a key finding in this literature, it's still an ongoing literature, but in the last 10 years, there was a lot of improvement and a lot of new theoretical results. A key concept is that this covariance matters a lot. So if I look at whose disposable income changes the most, and what do they do with that disposable income? How do they respond with their consumption to that disposable income? That matters a lot. And if this correlation is positive, then heterogeneity can have a big impact on the aggregate. So that's an important dimension of heterogeneity. But there are all sorts of issues, mainly measurement issues. Namely, we don't observe consumption. We don't observe disposable income, typically. Consumption we don't observe because normally what we have is consumption from a survey, which has noise in it. Or even if we have administrative data, like Fageneng's work in Norway, for example, we have to impute consumption. So we don't, that's expenditure. We don't know actually what they have spent. We don't observe disposable income. Typically, we work with labor income because that's easier to observe. But that's not the only component of income, and disposable income is really what households use as a state variable, right? And then, of course, there are all sorts of dimensions of heterogeneity that are relevant for this choice that are also difficult to observe. So in this paper, we have the privilege to observe all of these and make some measurements. So our motivation is that this interaction that Antonella has spoken about as well, that heterogeneity impacts aggregates, aggregate shocks impact people heterogeneously. There's a continuous interaction between these two, and in equilibrium, something shapes. And we'd like to ask whether this is salient in the data. So the question in particular that we're asking is, does heterogeneity amplify aggregate shocks? So at the end of this interaction in equilibrium, does heterogeneity have a role, amplification role, over and beyond what the aggregate shock is causing? And which dimensions of heterogeneity matter? We use a joint distribution of income, wealth, consumption, household characteristics. And we provide measurement with a very simple organizing theory. Our approach is to provide sufficient statistics, perhaps a bit of a strong word to say sufficient statistics, but what we do is we use totaling, we ask what is the impact of a 1% total income change, let's say there's a recession, for example, on aggregate consumption, decompose this to the individuals. Who is most impacted, whose income falls the most, how do they respond with their consumption? We estimate their MPCs and calculate the MPC distribution for Norway. And then we derive sufficient statistics for aggregation, basically talking about this covariance that I had on the first slide. And then, even with perfectly insured households, there might be heterogeneity. They might make different decisions about how to save, what kind of assets to hold. So in the second part of the paper, we, instead of calculating MPCs, MPC calculation also has all sorts of issues. We look directly at the impact on consumption. And we have a case study looking at the biggest recession that happened in our sample, which was the Great Recession. Today, for the sake of time, I will focus on the first measure, also because that's a model-free measure. We find that if you look at labor earnings, like the literature has done, then there is amplification. And income risk and cyclical inequality is important for that amplification. But if you look at this, if you use disposable income, there's no amplification. And we even find a moderate dampening role of inequality. And here the key is the other components of income apart from labor income. And finally, when we look at directly at consumption, we find some amplification, but very, very mild. And here, the key terms is how households make precautionary savings, how they save in liquid assets. We contribute to three branches of literature. Our contribution is in the measurement. We contribute to the Hank literature. We use their framework to frame our measurement. We estimate MPCs. Their contribution is that we can see the actual consumption. And we also contribute a bit to this massive literature on inequality. Here we have better metrics of individuals and households, basically. So let's look at the sufficient statistics. What we are interested in is amplification, which is very easy to explain when we have only one household, representative agent. So let's take this very simple example. Let's assume consumption is some function of income, interest rate, and some other things. And there's a, let's say, contractionary monetary policy shock, interest rate changes. Then we just have to take all the derivatives of this implicit function. And the direct effect on consumption is the last component here, direct effect of the interest rate on consumption. But the interest rate also changes income, and households respond with their consumption to income. Extreme case, let's say there's no taxes, there's no government, closed economy, income must be equal to consumption. We can substitute that in. And there, what you get is, apart from the direct effect of this interest rate change on consumption, there's an amplification, there's a multiplier in front that depends on what we call aggregate marginal propensity to consume. Here, there's only one individual, of course. But the amplification comes from the fact that this household increases consumption, that increases input. That's an earning for the household consumes that input, and so on and so forth. Now, as soon as you have two agents, this is not so simple. So I will not talk much about it, but Florian has a paper where, with some strong assumptions, he's able to derive some closed-form solutions. Here, what you see is if there are hand-to-mouth households who just consume their income and savers who can do intertemporal smoothing, then the direct effect depends on the share of savers, because they are the ones who can move their consumption. But the multiplier depends on the hand-to-mouth households, and this beta is how their income is responsive to a recession, let's say. So it's because when the savers increase consumption, that turns into output. That's an income from the hand-to-mouth households. And the MPC of hand-to-mouth households is 1, basically, theoretically. They are the ones who eat everything they receive. So the amplification depends on them. But of course, there are strong assumptions in this. So we have a more general formulation. So what we do is we calculate aggregate marginal propensity to consume. What's the change in consumption when aggregate income changes? Well, we can just sum up all the individuals. First, let's say there's a recession. This will load differently on different people. This is what Guvenen calls income beta. This we calculate in percentage terms. So this is log derivative. Then these people will change their consumption. That depends on their marginal propensity to consume, which is also heterogeneous. And when we add them up, we have to take into account their income share. So this is a model-free metric. You can rewrite this as sample-weighted average of these income betas as an average marginal propensity to consume that we calculate as assume everybody's income beta, income sensitivity to the recession is the same. So we just take the average multiplied with their income weight. And then the covariance between their marginal propensity to consume and their beta, income beta, sensitivity of their income to a recession. And we have amplification when this covariance is positive. So exactly those people change their consumption the most whose income has declined the most. Or another way to look at it, when the average marginal propensity to, when the aggregate marginal propensity to consume is bigger than the average. So let's get to the data. The Norwegian data is very nice. It's high quality administrative data. There's a wealth tax. So we know the wealth of people. And importantly, this wealth is reported by third parties, financial institutions. So if I take up a mortgage, the tax authority would see exactly how much mortgage I took, what's my deposit, what's the debt that I have on my account, and this is reported by the bank. And when I file my tax return, all I have to say is the numbers that are already there, are they correct or do I want to add something? Income is also high precision because it's reported by the employer. And then taxes, and we see taxes and transfers and capital income as well. We use working age population and we see household characteristics, what kind of sector these people work as well. The new data that Norges Bank purchased quite recently is the so-called transactions database of consumption. So this is data that's coming from one of the biggest clearing houses in Norway that's cleaning 80% of the market. So for 80%, we see what they spent on their debit card and what transactions they did on their bank account. We don't see cash payments, but Norway is a more or less cashless economy. And then consumption is debit card payments, bill payments, so payments, bank transactions to another entity. And we exclude consumption from housing. This is how the aggregate data looks like. The red one is the national accounts. The blue one is our consumption data. You see that as time goes on, we go closer to the national accounts. And if you look at first differences, the two are very correlated. So the first thing we do is we estimate these income betas. We do nothing fancy. We follow a paper by Guvenen, and we find something that's very similar to what he finds. So we estimate, we put labor income here, and estimate what's the loading of aggregate income change on labor income, and we estimate this for groups. The groups are based on individual characteristics and past average earnings. And what we find is the same, so this looks very similar in the US. Those at the bottom of average earnings, their income is very sensitive to aggregate income changes, and those at the top is also very sensitive. Heterogeneity analysis across age and gender is also similar to the US. Then we estimate MPCs. We do that also for groups. So we take our consumption data, and then we take the change in disposable income for households with characteristics X, where X contains age, gender, lagged income bins. So we estimate this coefficient, controlling for time and spatial controls. But of course, the income change, this in disposable income, that's not an exogenous shock. So what we do is we instrument that with the shock of becoming unemployed. So if you were employed in the previous period, now you're unemployed, then we consider this as an income shock to you. Advantage of this is that we can then calculate MPCs for the whole population. Disadvantage is that this is not a clear transitory income shock. So, okay, this is how we impute MPCs. As a robustness check, we use the Jean Como version of the Blundell-Pistafari-Preston estimate to counteract the effect that this is not a clear exogenous shock. That's a semi-structural estimator using time series and cross-sectional patterns of income and consumption. This is how the MPC distribution looks like. So the first thing to note that the MPC is average MPC is quite big, around 0.3. And there's a lot of heterogeneity. There are not so many people who estimated the distribution of MPCs, but this is quite a general message on US data as well, that there's a lot of heterogeneity in MPCs. Then what we do is we put these people into MPC bins, so take bins from this distribution, and then re-estimate this income, given n type of income beta, their income sensitivity. Before showing you those results, let me show you some heterogeneity. Sorry for the small fonts here. The only thing that really seems significant is education is an important driver of MPC heterogeneity, and those with low education have higher MPC than those with high education. And when we group households into hand-to-mouth, non-hand-to-mouth, using the Kaplan-Violante measure, which is based on liquidity being smaller than 2 weeks of income, then those who are hand-to-mouth also have higher MPC. So let me show you the estimations for the MPC bins. So first we do exactly the same as what Christina Pettersson already did in a paper. Here on the horizontal axis, you see the MPC deciles. So from the MPC distribution, we bin people into these deciles. We estimate the sensitivity of their income to a drop in GDP on the left-hand side or a drop in average income from our data on the right-hand side. The pattern is the same as Christina finds in the US. So exactly those who have high MPC are the ones whose income, labor income, is most sensitive to a recession. So that would generate a lot of amplification. But here's what you find with disposable income. It flattens out, even turns around. So now those who have low MPC, so they don't really respond to an income change, their disposable income is the most sensitive to a recession. So let's decompose this because we see all the components of income. This is if we add capital income. And you can see that for those who have low MPC, if you add their capital income and their labor income, their income becomes more sensitive to a recession. And then if you have taxes and transfers, they are the ones who are paying most of the taxes and receive least of the transfers. And the opposite is true for the high MPC people. They receive a lot of transfers and pay little taxes. And this redistribution is actually important for household decisions. So is this just Norway? Of course, in Norway, there's a lot of redistribution. So what we do is we take our data, but now impose US taxes and transfers on it. And what we do is we use Axel Ferrier's estimate that has a flat capital income tax and has an estimate for both taxes and transfers. So first we estimated on Norwegian data. Here's the blue line is AXA's estimate. On the horizontal axis, you have labor income. And the red line is Norway. So you can see that those with high labor income have higher taxes in Norway. And the reverse is true for transfers. If I bin people into labor incomes and plot the data, that's the blue line. The green line is our estimate for Norway, just to see that her formulation is okay for Norway. The two are close to each other. And the black one is if you impose US taxes. So you see that especially here at the bottom, there's a big difference between the two. And there would be less redistribution if Norway had US taxes. Of course, if Norway had US taxes, then these households would make different decisions and the general equilibrium would change as well. Here, you can think of it as a first step towards that. That's what we can do with our data. Now, if we redo the same estimate, look at this line in the middle, that's what we get with US data. So basically, we still wouldn't have amplification if Norwegian households paid US taxes. It would flatten out. So that's somewhere, if we had US taxes, our estimates would be somewhere between what we have and what comes out from labor income. The next thing we do is, of course, our MPC estimation is based on a shock that's not a transitory shock. So we re-estimate, we group people into quintiles of their income beta, and we do another type of MPC estimation based on Jean Comeau's method that builds on Blundell, Pistafer, and Preston. And what you see here, the blue is the original estimate with unemployment shocks, and the red one is the semi-structural estimator. It is lower, but not significantly lower across the bins. That's because the unemployment shock can be persistent, but it is flat across these bins. And finally, we calculate the aggregate MPC and average MPC. For Norway, the difference of the two is this covariance. So let's focus on, for the sake of time, on the covariance. If you calculate the covariance with labor income, you find a positive covariance, that's what you have seen on the graphs. If you add capital income, it's slightly lower, but if you had transfers, that's when it turns negative. And with the US counterfactual, it's also slightly negative. So to conclude, we find close to no amplification in this data set through unequal incidence. So through a recession impacting people heterogeneously, impacting their income heterogeneously. And the important metric for this measure is to use disposable income, not just labor income. I'd like to know that heterogeneity still matters, of course. There's still inequality in MPCs, and that matters for was the first step, the direct effect. But we find no amplification beyond that. And it's still important, you know, even though there's no amplification, that doesn't mean that policy doesn't have a role. Given the MPC heterogeneity, targeted transfers would still have a role. That's it for me.
The discussant is Morgana Richard. Do I pronounce it correctly?
Yes, absolutely, Richard. Richard, thank you so much for having me discussing this paper. It's been a fantastic read. All right, so the broad perspective is that in the Henk literature, we do have a two-way feedback mechanism between the macro variables and the distribution of micro variables. And the amplification, you explained it really well, comes from the fact that in these models, we have these low-wealth households who are at the same time the most affected in recession, but also the most responsive. So the goal of the paper is to provide some measurement for this amplification. In other words, the question is, does heterogeneity amplify the aggregate effects of demand policies and shocks. How do they go about it? Well, they have this wonderful individual level matched data that have the personal characteristic, the income, the wealth, but also the consumption. So with this, they compute the distribution of MPCs, the elasticity of individual income to the aggregate one, and the elasticity of individual consumption to the aggregate one. Using this, they provide two sufficient statistics for amplification. The first one is the one that you're focused on today, but this is the one that is about income, and it's following also the method by Patterson 2023 of these aggregate MPC and the multiplier. The second one, I'll talk about it a little bit as well, is about consumption directly, the consumption beta, so it's about the cyclicality of consumption inequality, and it is based on a theoretical framework, a tank model. What do they find? Well, so they estimate some unconditional MPC of 0.38, so quite large. When we look at the first sufficient statistic, the one with respect to income, if we think about income as the way it's done in Patterson, labor earnings, we do have that the result of Patterson do replicate qualitatively, meaning that heterogeneity is responsible for some amplification. This is coming from the fact that the high MPC individuals are the one whose labor earning decreases the most in recession. This covariance is negative. When we look at the actual quantification, I'll come back to this, we're still quite different. But then what the paper does, and that's great, they rethink about what definition of income to use. And if we do the same methodology but think about disposable income instead, the result overturns, meaning that now heterogeneity is responsible for some dampening. And it's the case between is the household with the highest MPCs whose disposable income decreases the least in a recession. Why so? Well, because of the automatic stabilizers, taxes and transfers. Now, they look at the second sufficient statistic, the consumption one, and when thinking about this consumption beta, they also find that heterogeneity is responsible for amplification, but quite mild, at most 12% in the worst episode, which is the Great Recession. Okay, what's the difference if we think about the amplification with respect to income or consumption? Well, this comes from the cyclicality of savings. All right, I think this is a fantastic paper on an absolutely first-order question. I think revisiting the MPC estimate with this wonderful data is great. You actually observe the consumption, you do not need to impute it. And not only that, but you jointly see this consumption, all the measures of income, the wealth, the personal characteristic for this high coverage of Norway, so this is great. I think this is super interesting that you find that still high income, high wealth households do have some substantial MPCs. And I really like the fact that you use different definitions of income, which is what we should care about. I think it's also nice that you have some empirical framework, theoretical framework, sorry, that guides your empirical exploration. So yeah, I'm really on board with this. Now I have a bunch of comments. The first one is more about the way you present your first result, the way you interpret it. And this is about the first sufficient statistic. So the whole story is like, okay, in Norway, we don't have a lot of amplification. If we do the way that it's usually done with labor earnings, qualitatively we replicate the literature, but then if we switch the definition, our result overturns and the new amplification comes from that. I do completely agree, it's an important factor, but I'm not sure it's the entire story. And I think if we look at when we compare with labor earnings, which is the same variable that is used in Patterson, the sign is the same, but the quantification is quite different. So this important variable, that is the covariance between MPC and the income beta, in Patterson is between 0.06 to 0.099, and you find 0.016, or ISO 17 in the new version. But so this is quite, there is still a delta, so we need to understand something else than using disposable income is potentially at play. Before coming to that, hold that thought when we are on disposable income, you're computing the disposable income beta at the individual level. And I think disposable income is a measure that makes a lot of sense when we think about at the household as a unit of observation, because some transfer are household specific, but also some tax, you mentioned the wealth tax. You do it a little bit in the appendix, but having maybe the main specification being that, I would have appreciated it, I think. Okay, so now we'll come back to our main question. There is low amplification. Part of it is due to disposable income. Part of it is due to something else. maybe this is also due to the fact that you find your MPCs, if we look along the income distribution, are actually quite homogeneous, at least compared to what we have in the literature. Here, so I'm borrowing the plot from Patterson 2023 and from the paper. So this is the estimates of the MPC for different levels of earnings. So low, medium, and high income. And so they look different, but they should look even more different because the scale is different. So from Patterson, you go from 0 to 1, and from the Hang Seng, from 0 to 0.5. So basically, Patterson finds MPCs ranging from 0.2 to 0.9, and in this paper, we find it from 0.4 to 0.45. So we do have, maybe this is coming from the fact that we have quite homogeneous MPC in that direction. And potentially that's why when you play around with the US tax system, you don't find much happening. So this is about interpreting the results. And if this is the interpretation we take, I think I would like some discussion on some of the sample selection that potentially are consequential in this regard. So I'm doing durable consumption, so my first point will be about the fact that you do remove large purchases out of your consumption data. And I understand why you do this, but I don't think so. All the purchases above 12.5K in US dollars, I think this might not be totally neutral because you're probably removing a lot of durable goods, these large ticket items. And we've seen from the literature, for instance, the Orchard, Whelan, and Rame paper, that the MPC out of durable is the largest one, and this is driving the MPC estimates. So this matters for the levels, but I think it also matters for the distribution. Because when we think about durable consumption, we have these lumpy purchases, the non-convex adjustment cost, and it interacts with risk. And so the risk and how the risk varies over the business cycle will be different where you are in the income distribution. So I think it also matters for like how different your MPCs are if you added this. The second thing, I'll be quicker on that, is you're also removing self-employed households, once again, for very reasonable measurement considerations. But I think these households potentially have low liquid wealth and would be the wealthy hand-to-mouth. So I would like to see a bit of a discussion to this. All right, my second comment is about the second sufficient statistic, and you said that quite a lot. It is model-based. And so it is derived from a TANK, so two-agent new Keynesian framework. And what I'm not sure I fully understand is how it can be fully generalized to a more standard Hank framework, in the sense that I think that in Hank models, one very important margin is how the expected intensity of the credit constraint varies over time. Meaning that if I'm an agent that's not hand-to-mouth, I'm on my Euler equation, but I still expect that in the future, I might become hand-to-mouth. The credit constraint might bind. And I take this into account when I make my consumption choices. And if this risk of becoming constrained is changing over the business cycle, I think that there would be some extra amplification. And I think your framework doesn't capture this, well, because in the main specification, the hand-to-mouth and the not hand-to-mouth can never move from one another. And you have an extension in the appendix, but the probability to become one or the other is fixed. So I think potentially having this margin, or at least discussing how generalized it can be. My last point on this is also, I would think it would be nicer to have a bit of a discussion of how to weave this tank with your empirical results, because in the tank, theoretically, the hand-to-mouth have an MPC of 1, the not hand-to-mouth of 0. And then in just above, you just computed these values, and you find 0.41 and 0.51. So it feels a little bit like, oh, but I just thought I read something else. So maybe discussing this, articulating this. And in the 30 seconds I have left, this will be the last point I have. So it's more about the interpretation. So heterogeneity, well, I think this is a very important topic. And I think you're finding at most this 12% amplification during the Great Recession. You're talking in the draft at least about quasi-irrelevance. I think 12% is quite relevant. So, so this is about like how we should read this result. And finally, maybe it doesn't matter so much for aggregate variables, but it will still be very consequential if we think about welfare. So I think it's important to keep maybe that in mind. And I am out.
Thank you so much for the wonderful discussion. At the moment, we are in the process of trying to understand why we get less amplification than in the US. Yeah. And I think excluding durables is probably an important component of that, so we'll absolutely check that. Our goal was to come as close as possible to non-durable MPCs, but given that the other estimates in the literature are having the durables, and durables are like investment households. That's the first thing they cut in a recession. That's probably an important point. Thank you so much. Expected probability of becoming credit constrained, that's also something that's very important. Our analysis so far is very static, but of course there are dynamic impacts of demand shocks as well that we haven't checked yet. And there could be, we could check dynamic impact on consumption or IMPCs as well.
Thank you. So we can open the floor to questions. Helen, and then here.
Thank you. So I think it is a very, very important line of research, and so great session. And I also think it would be great to do that across the countries of the euro area, if it were possible. Obviously, for the ECB, that would be fantastic. I wonder if you could say a little bit more about the persistence of the shocks here, and because that may also affect, the time variation in this marginal propensity to consume. So you mentioned it a little bit, but I think it would be great. You do have a lot of information in this data, so maybe you can go a little bit farther on this. And then also what is very interesting is, in the comparison to the US, the access to credit, right? So the indebtedness of households. Can you say maybe also a little bit more along those dimensions? So probably the access to credit in Norway is quite different from the US. The role financial markets play with this regard would be also an interesting extension, I think.
Daria?
Thanks. I'm Daria Finocchiaro from the Swedish Riksbank, so a neighbor to Norway. I always think I have two comments, and then something also related to what Morgan said. One about MPC being so flat across different income in Norway. I wonder if you thought about the role of social insurance, if that could play a role. And here I'm thinking that one of my colleagues at the bank is working on papers showing that also ex-ante heterogeneity and exposure to risk matters for MPC. So it's not only about, so that could play a role and explain why you have flat MPC in Norway. And the other concern, if I recall right in one of these thousands Norwegian papers, this very great data that I saw, shares of hand-to-mouth don't vary so much over time. So in a sense, it's like if that doesn't change so much over time, it's not such a, to take a tank approximation is not a big problem. It would be much a big problem if shares, of course, varies over time. But maybe, yeah, so that's.
You want to take this, and maybe we have another round?
Yeah, so the persistence of shocks, typically if someone becomes unemployed, it takes about a year to get back to the previous income level. That's also coming out from an estimate of a paper by Fagereng on how much people consume with imputed consumption from an unemployment shock. So in the Como estimates, Como BPP estimates, we take that into account. So we take into account the persistence of income when we calculate MPC. And that's why we have slightly lower MPC estimates with their method. But the important message from there is that it's still a flat distribution across income betas. Access to credit, it's quite easy to access credit in Norway. Let me just say that for the sake of time. So that's a potentially very important difference between the US. Flat MPC could be a result of social insurance, but I think an important finding we have is that it's not just social insurance but it's capital income as well. Capital income has an important role in flattening this curve and lowering the covariance. Share of hand-to-mouth households and how that evolves over time. We started looking at that. I can't say a lot. It's quite a persistent state, but there is also time series variation in recessions. There are more hand-to-mouth.
So I want to give the last question. Yeah, just two comments. So there's I just to reinforce what Morgana's point about the cyclicality of risk, because there is cyclicality of inequality, which was you focus on, but the cyclicality of risk is quite important. And as we show in our paper, the unemployment rate may generate a lot of amplification. So that's something that I think is absent from your analysis. The other comment is just about a little bit, maybe I'm wrong, but about the narrative. Because you say heterogeneity, once you look at disposable income, dampens. But shouldn't we rather say heterogeneity amplifies, but then countercyclical policy does what it's supposed to do, right? Not only stabilizer, but also countercyclical policies, and they then, it's not that heterogeneous. So this is just about language, but I think the message you give is very different.
I like your language. It's almost like a proof of concept. Good policy works.
And this can also be discussed further at the break. Thank you very much for a very interesting session.
Good afternoon and welcome to the last session of the We Are In conference. It is a pleasure to open this afternoon session on monetary policy with Jan Bai from Rochester University and Oskar Achinki from the Federal Reserve Bank of New York. And now we will discuss about monetary policy and sovereign risk in emerging economies. And Jan, you have 25 minutes for your presentation. Thank you.
Thank you. Okay. First, I'd like to thank the organizers to have our paper in this program and in this wonderful conference. This is joint work with Christina Ariano from Minneapolis Fed and Gabriel Michalik from the Ohio State University. So since 2000, many emerging markets have reduced their inflation to single digit. And then they have achieved, their central bank have achieved independence. So as in advanced economies, the monetary policy in these emerging markets use nominal rates to target inflation. And we all know that the New Keynesian model is provide this toolkit to understand or to provide justification for why we use inflation targeting. And this has been widely established in developed countries. It's a good theory for developing countries. Okay? However, such theory abstracts from sovereign default risks, which is a major source of fluctuations in emerging markets. In this paper, we bridge the gap by providing a New Keynesian model with sovereign default risks. And in the model, as in the data, the sovereign risk and monetary policies are both important for economic activity and inflation. So before I show you the details of the model, let me first give you some ideas what emerging market inflation look like. So here we have 8 emerging market inflation targeters. And on average, their inflation is about 4%, single digit. And it's also quite stable, with a standard deviation of about 1.8%. And we also construct some inflation events using this country's data. And by inflation events, we meant that when inflation increases above 2 standard deviations of the mean of each country. So we have about 9 inflation events across countries and across time after 2000. And on average, and also among all those inflation events, we see that there's a temporary increase in inflation. The sovereign spread of this country's foreign currency denominated debt also went up, and so are the domestic policy rates. And most importantly, all these variables return to low level within a year. So we use our model to account for these empirical patterns. And then using the model, we can perform counterfactual analysis to understand how sovereign default risks shape the inflation dynamics and how monetary policy in these countries affect sovereign spread. So in particular, our model has a New Keynesian model with sovereign default risks. And the government borrows state uncontingent debt with default risk. And the inflation is determined by firms' pricing decision. So it gives the standard New Keynesian Phillips curves. And in our benchmark model, we consider a Taylor rule as the monetary policy. Okay? And we identify 2 unique mechanisms in this model. First is we call it default amplification. Okay? The default risk actually exacerbates inflation. Why? Because during the default event, there is a lower productivity and may also have loose monetary policy, and that generates high inflation. And during default events, consumption is also low, because the country is facing this limited capacity of borrowing. With this with this high inflation and low consumption during default, that means that the marginal utility is very high during the default event. And now, in the current period, if I forecast that future there's a high default risk, I'm going to have formed this expectation that inflation will be high and the marginal utility will be high. And then firms anticipate this high inflation. They're going to increase the current inflation already. Okay? And that's why the default risks actually work as a cost of push-up shock, will increase the current inflation. And that's what we call a default amplification. The second mechanism, we call it monetary disciplining. Okay? The reason is because with this monetary friction, it actually can lower the government's borrowing incentive and lower default risk. Okay? So borrowing, the reason is exactly because of the existence of default amplification. Borrowing with default risks will bring in this costly high inflation. And that's make the government internalize that if I borrow too much, the current inflation is high, and that is very costly. And also, the marginal utility is high. That would tend to depress current output because of low demand. Okay? And so that's the reason that with monetary friction, the government's borrowing incentive is lower. And that is useful because the governments tend to overborrow and generate too much of default risks than what the household desired. In our quantitative part, we show that our model can generate the moments consistent with the empirical data. In particular, we can replicate this co-movement of inflation, sovereign spread, and domestic policy rates. We can also replicate the inflation events that I just showed you. Okay? Using our model, we can conduct a counterfactual analysis. We show that default risks actually account for almost half of the increase in inflation during inflation event. And our model has this monetary discipline mechanism. That means that if there is an increase in monetary policy rate or a contraction monetary shock, that will lower sovereign spreads. And this is consistent with the empirical results we get from local projection method of use regress spreads on monetary shocks using panel data. Okay. I want to emphasize that the mechanism of default amplification and monetary discipline are robust to the currency denomination of debt. So no matter if the debt is denominated in foreign currency, say US dollar, or local currency of emerging markets, of each own emerging market's own currency, okay, our mechanism still there, and then the quantitative results is consistent with what we find in the baseline model. Okay? Because the key thing is the sovereign default risks. Okay? And also, the result is very robust to our assumption over what's the punishment during default. So with this validation of our model, we can use the model to evaluate alternative monetary policy rules. The first rule we consider is the strict inflation targeting. Okay? Here, we assume that inflation is always at its target. Then, given this is the case, there's no monetary friction. However, because there's no disciplining over government's borrowings, so it generates excessive default risk in this model. And so it tends to lower the welfare. Alternatively, we consider this rule of but monetary policy target not only the inflation, but also default risks. This rule will generate low monetary friction and also low default risks. So this rule would can dominate the strict inflation targeting. So this is very different from in a model without sovereign default risks. Galli and Monticelli in their 2005 paper, they found out that strict inflation targeting is the optimal rule. With sovereign default risk, we found out that it is not optimal anymore. And lastly, if the debt is denominated using local currency, the government has extra incentive to inflate away the debt. So in this case, if the monetary policy is set at the government's discretion, it will generate high inflation, high spread, and give us the lowest welfare. Okay, so now let me show you the model. We have a small P economy model, has 3 types of agents: the private sector, monetary authority, and also fiscal government. But the private sector includes the government, a household who value both domestic and imported goods, and the household also supply labor. The intermediate goods producer, they produce with labor, but then they're subject to these price-setting frictions, and we model it as a Rothenberger way. And then the final goods were just being consumed both domestically and also being exported. The monetary authority in the benchmark, we assume it follows interest rate rule and that target inflation. And then the government can borrow internationally in foreign currency denominated debt, but it can choose to default. So the households will value the consumption of both domestic goods, C, and imported goods, CF, and also supply labor. Okay? And the household will have a labor income, has the profit from firms, and also fiscal transfers from the government. Okay? So as in the standard in the sovereign default model, here we assume that household cannot borrow and lend internationally. Instead, is the government can borrow and lend internationally on behalf of households, and then the government will rebate all the proceeds back to household using a lump sum transfer. Okay? And then the household's problem can be characterized with 3 equations. The first one is the domestic Euler equation. Okay? So here, IT is the monetary policy instrument, and the pi t is domestic PPI inflation. Okay? And then we also have the relative price between imported consumption and the domestic consumption, which is given by the ET, the terms of trade. That equates the marginal rate of substitution between imported consumption and domestic consumption. And then lastly, we have the wage equates the marginal rate of substitution between leisure and consumption. Okay? The intermediate goods firms will use a CS demand function, and they produce with labor with the linear production function. And then we have this standard NKPC condition that current inflation depends on the marginal cost of production and also future expected inflation. Okay? And we can also define the monetary wedge as the gap between marginal product of labor and also the marginal rate of substitution between leisure and consumption. So the higher this wedge, that means that the output is more depressed. Okay? And then the goods market, we have an economy will face this elastic demand for exporting. And then we have goods market cleared, monetary policy is set with the interest rate rule. And MT is the monetary policy shock. And then we have the government will borrow internationally using foreign currency denominated debt. So the imported consumption can be financed with both export and also the government borrowing. We also assume that government is less patient, so the beta G is less than beta, and they can default on its debt. Okay? After default, the country is being excluded from international financial market temporarily, okay? And there is also a loss in the productivity. And the country may also face an enforcement shock. Okay? And because the country or the government can default, and so the bond price schedule will compensate for the losses of lenders during default, and so it reflects the default risk. Okay? And then here, we solve the government's recursive problem. The state of the economy is given by 3 shocks: productivity shock, monetary policy shock, and enforcement shock, and also this state level of the debt level of B. Government first choose to repay versus default. If default, there's a loss in productivity, and also there's the enforcement shock, cost. If the government chooses to repay, the government can continue to borrow, and subject to all the private equilibrium and also monetary policy rules, and also take as given all the future government's policies. So here we consider a mark of perfect equilibrium. Okay? So that's the model. Let me emphasize what's the mechanism. The first thing I want to say is there are 2 frictions in this model. There are pricing friction, and also government tends to overborrow for 2 reasons. First, the government has a lower discount factor than the household. And second, the debt is in our quantitative model, we have long-term debt. So the government tends to dilute the long-term debt and also generates this overborrowing incentive. And then I want to identify to have two mechanisms. First one is the default amplification, meaning that the default risks would generate high inflation and high monetary wedge. And we also have monetary disciplining that tightening monetary policy would generate lower default risk. Okay? So the default amplification works through the two conditions. First is this New Keynesian-Phillips curve. Okay? Just because of the future default risk will increase, default will increase future inflation and also lower future consumption. So it tends to generate a higher expected NKPC terms, and that generates push up the current inflation. And the other thing is because of defaults tends to lower consumption, so future marginal utility is high, UC prime is high, and because of the monetary friction, real interest rate cannot adjust freely, and that will increase current marginal utility and lower current consumption. So it generates higher monetary wedge or a more depressed output. So that's our first one. And then we can also show you that the monetary discipline mechanism. So the economy actually can choose strictly inflation targeting. In this case, there will be no frictions in the domestic economy. But it would generate these overborrowing incentives of the government just because the government has a lower discount factor. Okay? On the other hand, if suppose we increase the nominal interest rate in this economy, okay? So then domestic economy is not friction, is not efficient anymore, and it tends to have lower demand and lower output. And this actual depression of the domestic economy will show up as in this borrowing wedge show up in the government's first order condition. In particular, we can show that is as long as this interest rate is higher than the interest rate under the strictly inflation targeting case, the wedge is positive and the government's borrowing incentive is lower. So that's our monetary disciplining incentive. And we actually can design an optimal monetary rule in this simple example by showing that if the government is simply targeting some inflation rate, some default rate, okay, by targeting that, the government can eliminate both frictions, the pricing friction and the overborrowing incentive. Okay? So this motivates us in the quantitative part. We're going to consider a rule that target not only inflation but also default risk. So the quantitative analysis, we parameterize our model to 8 inflation targeters. And then we're going to highlight the mechanism using the policy rules and impulse response functions. And we also compare our model with a model without sovereign default risks, the NK reference model. Okay? And that's very similar to Gallimard-Cheney's 2005 paper. Okay, I'm going to pass the functional forms. Most of the things are very standards here. And this is the moments we targeted and untargeted. So we matched the average CPI inflation, domestic rates and spreads, and also their volatilities. I think the most important thing is this out of sample moments. So we generate this positive correlation between sovereign spread and domestic inflation, and also the correlation of sovereign spread and domestic policy rates. Okay. Let me show you the policy rules just to emphasize this mechanism of default amplification. So here, the x-axis is the debt of the government. And in each picture, we have 2 lines. The right dotted line shows the default risk. So it's not surprising that when the debt increases, the government has to borrow more to repay the debt. And that's why there's an increase in sovereign default rate. The default risk will go up. Okay? And then we have some standard implications over here. When the current debt level is high, the country will have to lower its domestic consumption and lower its imports to repay the debt. Okay? At the same time, because you repay the debt, the terms of trade actually depreciates so that you can export more and to repay the debt. The output at the beginning increase and then decrease. The decrease is because due to the default risk. The interesting part is the inflation and the monetary wedge. And you can see that because of the default risk, when the debt level is very high, output actually remains at inflation remains at a high level. Okay? That's what we call the default amplification. And similarly, the monetary wedge is very high when the default risk is high. And that's, again, is because of the future default risk generates a lower current consumption, and this lower demand also lowers output, and that increases the monetary wedge. To show the monetary discipline mechanism, we consider an impulse response to monetary shocks. And an increase in monetary shock first will increase the nominal interest rate and decrease the domestic inflation. So that's a standard. But then you can also see that the government also chooses to borrow less, so the debt level falls, which generates a lower spread. So we show that is the model has this feature that high monetary policy shock lowers government borrowing incentive and also spread. And to show this is actually also in the data, we consider a regression, a local projection model will regress sovereign spread to monetary policy shocks. And the monetary policy shock, we get it from, we purge the nominal interest rate to get it from the Taylor rule. Okay? And then this picture plots the coefficient of this beta H, what happens after the increase in monetary policy shock. The data is a monthly data. So first 3 dots, which shows in the first quarter, how much spread responds to the monetary policy shock. So on average, about a 1% increase in monetary policy shock, lower spread by about 0.3% in the first quarter. Okay? So model is consistent with the data in terms of monetary discipline. And then going back to the inflation event I've been showing at the beginning. So here we fit into the model two shocks, a productivity shock and also a monetary policy shock, so that the model can generate this inflation events, high inflation and also high nominal rates. And we can check what happens to the model's implication over output and spreads. So you see that because of, to generate this high inflation, productivity has to fall, and that's why it generates a lower output. And also the spread goes up also because of this lower productivity. And meanwhile, and we can show that is, suppose in this model without sovereign default risk, what happens? So with the same productivity and monetary policy shock, if we don't have default risk, the inflation wouldn't increase that much. So this comes from the default amplification mechanism from default risk. Okay? So we can show that is default risk actually account for about 45% of increase in spread in the data. Using this event, we can conduct another counterfactual analysis. It's assuming that suppose monetary policy shock actually stays quite high in the event, what's going to happen? So we consider this contractionary tight monetary policy. Okay? In this case, inflation wouldn't increase as high as in the data. The nominal risk is much higher. So it generates a little bit more recession just because of this tight monetary policy shock. But then spread in the dashed line is much lower than what we observe in the data. Okay? So this tightening of monetary policy shock, again, can lower sovereign spread by about 70%, but has a very mild recession. Okay? So I'm going to pass this. So in the robustness, we considered the local currency debt. We consider when you have rule or also when you have discretion when there's a local currency debt. Okay. With discretion, the government has an incentive to, again, to inflate away the local currency debt. And we also consider alternative punishment for default. Because part of the mechanism we get feels like it is when during default, productivity low, that's why inflation is high. So we shut down that mechanism. Okay? We show that is, as in the benchmark, default risk alone always leads to high expected marginal utility and also higher inflation. So as a result, our mechanism of default amplification and monetary discipline still hold with all this robustness. Okay. So in the model, we actually consider all sorts of scenarios. Like I said, local currency debt, and also different punishment for default. And we also consider strict inflation targeting or a rule that targets both inflation and also default. So here we plot their welfare against the equilibrium spread in all these types of models. So we find out that is, on average, you see that is when spread is high, it tends to have a lower welfare. Okay? And also we find out is strict inflation targeting can be dominated by our baseline Taylor rule and also default inflation targeting. So this is a contrast to Galli-Monticelli 2005, where strict inflation targeting is optimal. And also, the worst scenario is when you have a local currency, when you have a discretion on the local currency debt. All right, so let me conclude. Here we have an integrated framework for monetary policy and sovereign risks. We call it NK default. We identify two important mechanisms. Default risk would generate high inflation, and also monetary friction would discipline sovereign borrowings. And we think the framework is consistent with emerging market data. Thank you.
Thank you, Jan. And Otskar, you now have 10 minutes for the discussion.
Great. Thank you very much. Thank you, Katerina, and all the organizers for having me here. It's great to be back. It's my second time attending this conference in person, and I really enjoy it. So I'm at the New York Fed, so this is the usual disclaimer. The long version of it applies because we are in the blackout. So I'll start with a brief summary of the paper. So the paper is motivated by this empirical observation, which says that inflation targeting emerging market economies experience temporary inflation event over the last decade, 2 decades actually. So inflation co-moves positively with sovereign risk. So it means that high inflation episodes are associated with high sovereign credit spreads and high nominal interest rates. So the key question then is how fiscal policy interacts with the monetary policy in the presence of default risk. So to answer that question, the authors propose an open economy New Keynesian DSG model augmented with government default on external debt. It's basically bringing two types of frictions that we use in central banks together, which one of them is the sticky prices, the standard friction, and the other is the default risk. So what is the main finding? They showed that expectation of a default is in the framework that they propose in the standard New Keynesian model. Once they introduced the fiscal risk or default risk, this expectation of a default resembles like a cost plus shock in our standard New Keynesian models. And this means that for the central bank, it is much harder to stabilize the inflation. This is a very novel mechanism, very intuitive. So what I'm going to do in my discussion, so I'll first review the main mechanism, which Jan called default amplification. It's basically the following. So in the model, they think about the output collapse, and they generate the collapse in output due to a sequence of adverse productivity shock. But the key relative to Galli-Monticelli, or what they call the New Keynesian reference model, the effect of the productivity shock is amplified via the expectation of higher default. This is really the key. Then I'm gonna basically raise 3 questions. Their focus is mainly on the productivity shock to generate these inflation events. And my questions are mainly for future research because, as I understand, I mean, it's clear to you also, the paper is final, very polished, and it is revised for a journal. So everything you can think of the paper as an improvement is in the appendix. It's the total 100 pages long now, but I strongly recommend everyone to read. This is, even though it's a long paper with many robustness checks, you see the main intuition is very powerful to think about how this default risk could turn the shock into a cost per shock in this framework and make the job of the central bank to stabilize inflation more difficult. So my main questions will be on that, whether, because the focus is on the productivity or actually already a supply side shock. So I wonder if this powerful mechanism also operate for any shock that raise the likelihood of a default, like demand shocks. So the second idea that I'll bring on the table is that one can really think about the Monticelli, or what they call is the New Keynesian default model, to think about the global financial cycle facts. And I'm working, this literature is led by Helen Ray and Silvia Miranda-Agrippino. I have some work on that. Şebnem Kalemli, Özcan also have been thinking about that. But these R models have hard time matching some of the global financial cycle facts, which I will show in a minute. And this idea of new Keynesian default risk in emerging markets could be a way for them to bridge the gap between the implications of the model and also what we see in the data. Finally, when we think about the emerging markets, we always think about exchange rate movements, and in driving results, I heard little from Jan to talk about the role of exchange rate in driving the results. So very briefly, this default amplification. So when the economy is hit by an adverse shock, so agents know that basically it is an adverse temporary productivity shock. In our models, when it is temporary, in small open economy models, agents borrow internationally to smooth out consumption, so the external debt goes up. So in this model, as external debt, B prime goes up, the likelihood of a default increases. Remember, when default happens, consumption is low, inflation is high. So in expectation, when the likelihood of default increases, firms expect higher inflation. As you see here in the last term, the expectation term on the New Keynesian Phillips curve, inflation goes up, the future inflation goes up, but not only that, even if you don't assume that inflation is a function of productivity, when default happens, productivity falls, even if you don't assume that, higher marginal utility of consumption will give you a kick, so that at the time of the adverse productivity, firm is going to be increasing prices today in the presence of default risk. And under the standard Taylor rule, nominal interest rate then goes up, and through the earlier equation, you see the domestic consumption decreases today. So this is the key amplification channel that they think about. So this is in the graph. In the standard New Keynesian Monticelli, the red one, the only difference here is the debt. Like debt now increases, so it increases the likelihood of default. But this is powerful in the sense that this shock then gives rise to the core movement we see in the data: high inflation, high spread, low output, and also high nominal interest rates. Again, the main question here is whether you can generate such a pattern without the supply shock. Maybe think about the demand shock. How about the global financial cycle? What we know about that? So when the US monetary policy changes, we know that there are large effects in emerging market economies. So for a recent work, I was looking at some data, and here we collect quarterly data for many emerging market economies, 25 of them, and we estimate the local projection of the emerging market variables on the identified US monetary policy shock, starting from 1965. So this is just one example. You can find similar empirical estimates presented in Silvia Miranda-Agrippino's work with with the co-authors, in Helen's work. But here I want to focus on inflation because most of these papers on the global financial cycle think about the output and real macro variables and financial variables. Here, what we show when there is an increase in the federal funds rate, unexpected increase by about 100 basis points, and the effect on GDP decreases by 0.8% on the US. What happens on the emerging market GDP decreases more than the US. But headline inflation, which is including the imported inflation, which is also including the effect of the exchange rate, headline inflation increases a lot. But not only that, you see that in the short term, PPI, domestic prices goes up in emerging markets. Central bank in return, given the Taylor rule, increases the interest rate. Just to see a bit more clearly, because like Jan talked about the high inflation episodes, so one can interact with some vulnerabilities. Here I show, for example, if emerging markets have high inflation. So the red line is showing how the emerging market economy, GDP, inflation, and the interest rate respond to the US monetary shock when inflation is elevated in these economies. And as you see, especially look at the PPI and the nominal interest rate, they see that despite the big drop in output, their inflation at the domestic level is increasing and interest rates are higher. So how about Galli-Monticelli? Can Galli-Monticelli model, which they call New Keynesian reference model, can it explain this fact? No. Why? Because there are spillovers, so spread is going to go up, output will go down. But in Galli-Monticelli, this demand effect is very, very strong. So the producer price inflation will go down and the nominal interest rates will go down. So this is not hopeful to explain global financial cycle facts on inflation. So if I understand the mechanism correctly, New Keynesian default can be consistent with the observed spillover of US monetary policy to emerging markets. So I think we need to understand this is, extending it to two-country framework. One needs to understand what happens to the likelihood of default if, in the case of US monetary policy tightening, if the likelihood of default increasing, this expectation, even though it is like large demand shock, this likelihood, the expectation of a default could turn this into a cost push shock, and in that case, we might see in their model increase in inflation and a decrease in the output. So how I explain the observed core movement, high inflation, low output in my paper, it's building on my work with Albert Geralto. Our story is about unanchored inflation expectations because CPI inflation, given large depreciation, CPI inflation goes up, but agents are adaptive, not fully forward-looking. So we explain it by the use of New Keynesian Phillips curve is modified so that inflation expectations to some extent are unanchored. So this, I'm not going to go into detail, but this is one mechanism we think this could give us the core movement we see in the data. But I was so excited to see maybe their mechanism could be complementary. So it's a great paper, just looking forward to seeing it in print. So.
Thank you very much, Oscar. And Jan, would you like to react to the discussion?
Yes. Thanks, Oski, for the wonderful discussion. I think you explained pretty well our mechanism, I think better than I did. For the three questions you asked, first one is whether the default risk or the mechanism is still there if there's other types of shock. I think the answer is yes, this mechanism always be there, independent what types of shock, as long as the shock increase to future default risks. And that will work through, as you said, the New Keynesian Phillips curve, as the default risk will increase either increase future inflation or make marginal utility of future being higher. And so that work as a cost push shock, the increased current inflation. And then the shock you mentioned, this US monetary policy shock, I think that's a very important shock. We did not study in this paper. It will be interesting to see what is the implication on the model. But I think in addition to the Gaussian multi-channel mechanism you show, there's another thing is when there's an increase in US monetary policy shock in the model, it will increase the borrowing rates, the opportunity cost of borrowing internationally, and that tends to increase default risk if this monetary policy shock is persistent. And then that will work again through this default amplification, will push current inflation. But then how much, whether, which effect it dominates, I think is a quantitative question. It will be interesting to study in the future for that. And last one is about exchange rate movement. So in the model, as in the data for those emerging markets inflation targeters, exchange rate is flexible in this model. And so we can show that our exchange rate actually movements is consistent with the data, although it's not so volatile as in the data. Yeah, thank you.
That's great. So we have time. We have just 2 minutes, so we have time for a couple of questions. So there, Refat, and then Hélène.
Thank you. Great presentation and discussion. I was wondering what makes this a model of, in fact, a question of and a model of emerging markets. I could take the whole thing and label it the UK or France, and it seems to me that they would be exactly right. So is there anything that's particular to emerging markets here?
No, you're right. I think any country has a default risk, and also adopting the inflation targeting, it will fit those models. Although I wouldn't necessarily say it's a good model for France yet because of the monetary union, not because of default risk. Thank you.
So, and then Hélène, the last question, and Paula, maybe we collect both and you reply to both together.
Thanks a lot. So yes, great session. To reinforce what Özge said also, there's this interesting stylized facts. I think it probably still holds, but if you look at the CDS spreads of emerging markets, 80% of a variation is explained by essentially a global factor. So that would point towards the importance of, global shocks, including possibly US monetary policy, or, risk-on, risk-off shocks, or, which are possibly endogenous to US monetary policy, to be the main shocks effectively driving this. And I mean, for Refat, I mean, Shebnem and Özge have done a lot of work, right, on differentiating actually the effect of transmission, for example, of a US monetary policy shock to emerging market versus advanced economies. And, France is not, still not.
I agree. I think
that
right. I think the risk premium shock will be another interesting shock to look and to see whether the model can be consistent with what we identify in the data from the impulse response analysis. Yes.
Hello, Paola Di Casola from the ECB. Thanks for a very interesting paper presentation. So in the literature on sovereign debt, there has been lots of discussion about the use of long-term bonds in order to match the spreads when you do the calibration. So I wanted to ask you how important it is for the mechanism, the fact that you use the long-term bonds.
Mm-hmm. Yes, so you're right that here we use long-term debt. It's mainly being consistent with has been used in the literature. Another thing is long-term debt give another incentive for government to overborrowing. So borrowing too much and also generates too much of default risks is not efficient. That's why we're using long-term debt. But in terms of mechanism, I think we don't really need to have long-term debt. That's why in the simple example we have is actually short-term debt. Yeah. Thank you.
So we are perfectly on time for the break, and thank you very much for the very interesting presentation and discussion. And thank you, Jan. And now we have a very short break, so we can continue the discussion, and I will see you back in 10 minutes.
So welcome back to the session on monetary policy. Beatriz Gonzalez and Daria Finocchiaro will now present their work and thoughts on monetary policy and misallocation. And Beatriz, the floor is yours, and you have 25 minutes for your presentation.
Well, thank you very much to the organizers for introducing this paper into this program, and thank you to all of you for being here in the last session. We really appreciate. So I'm going to present Tale of Two Margins, Monetary Policy and Capital Misallocation, which is joint work with Silvia Albritz at the IMF and Dimitri Kametsin at the Banco de España. So I'm also affiliated with CENFI. I forgot to put it because it's very recent, but don't forget. So, well, as you all know, we've been discussing today a lot. Monetary policy is not only a demand-side tool, but we know that it can also affect aggregate productivity. And there are several papers that explain different channels through which this can happen. Changes in R&D investment, changes in the markup distribution, and arguably, monetary policy and productivity are really linked to financial frictions. This is the direct mechanism we would have in mind, and the allocation of capital. So the direction of this effect is ambiguous a priori. So if we think, like what we would think the standard mechanism is that monetary policy easing would relax credit constraints, and this would enable high productivity firms to expand, and this would improve allocative efficiency. However, if you were around during the time of flow for longer, you remember that there were a lot of concerns about what would happen with this easier credit that might allow these low productivity firms to be alive, what they were calling the zombie firms, and hence this would mean that we would be diverting resources and dampening the aggregate productivity. So this paper is relatively simple. The idea is relatively easy, but hopefully the message is powerful and it's policy relevant. So we want to understand whether monetary policy improves or distorts the allocation of capital across firms, and if so, through which channels. So this is going to be a purely empirical paper. We're going to use local projections with the quasi-universe of Spanish firms. And we're going to use the monetary policy shocks are going to be aggregated at the yearly frequency. So what we're going to find, in a nutshell, is that at the aggregate, monetary policy easing is going to decrease misallocation. I'm thinking about misallocation a la C and Clino. I'm going to be more precise in the next slides. And when we're thinking about through which margins, we're going to start thinking about what we call the intensive margin, or what are incumbent firms doing. And we're going to show that following this monetary policy expansion surprise, it is high MRPK firms that are ones that are going to invest more. So they're going to invest relatively more than the average firm, and they are going to also access more frequently the credit markets. They're going to borrow more. So it seems that this monetary policy expansion is actually decreasing these financial frictions. And we're going to show as well that this MRPK variable can be, seems to be a good proxy for financial frictions, because we're going to see that this variable shows a higher investment sensitivity to monetary policy than other standard, variables that are used as proxies of financial friction, such as firm age, leverage, or cash. Then we're going to move to the extensive margin, that is entry and exit of firms. And what we're going to show is that following a monetary policy expansion, there is a modest increase in exit and a decrease in exit rates, but that is quantitatively modest. And importantly, there is no significant change in the composition of entrants and exiters in terms of MRPK. Okay? So this is the paper in a nutshell. So what's new? I'm not going to go through all the papers. This is not an exhaustive literature review anyway, but what we're going to contribute is basically all these papers that are thinking about different ways to proxy financial constraint and getting these different sensitivities of investment to monetary policy shocks. We're going to put forward this MRPK variable as being, like, we think, a good proxy for financial constraints, we're going to see another channel through which monetary policy can affect TFP, and this is through the allocation of capital. And also we're related to all this literature looking at this declining interest rates, how this can decrease productivity. So Carolina has a paper on this. What we're contributing here, or what is different in our paper, is that we're looking at monetary policy shocks, so not just decreases in interest rates. So what we're looking at is different. And of course, we are related to all these papers looking at entry and exit and how monetary policy impact this margin. And what is new, aside from looking at Spain, is that we're going to look at this MRPK composition of entrants and exiters. So the data we have, the firm level data is from Central de Balances. So this is a firm level data set that is hosted by Banco de España. And we include all sectors but the financial, insurance, mining, and public sectors. And we match this with DIRCE data. So this is firm level data of entry and exit that is done by INE, and this combines different data sources, so tax, administrative, and social security records. Then we have monetary policy shocks. As I was saying before, we borrow Janowski Karadi. They are using this monetary policy shock based on high-frequency data and sign restriction, and we do some annual aggregation that resembles the quarterly scheme by Otonello-Winberry. We do have some I'm not going to have time to show you all the robustness we do. We do have robustness at the quarterly frequency for a subset of firms for which we have data. We don't have data for all these firms at the quarterly level, but we do have for a subset. And we're going to see how this aggregation scheme actually delivers us the same results, no matter whether we look at the quarterly frequency or the aggregate frequency, or the annual frequency. So let's begin with the overall effect. What is the impact of monetary policy easing on the allocation of capital at the sector level? So I don't know if everyone knows the CEPR framework. Basically, the idea is that within sector, if firms are maximizing, they should be equalizing MRPK. And if they are not, it is because there are some frictions on the back, some wedges that they have, that makes that there is dispersion in MRPK at the sector level. So if this dispersion is decreasing, this means that there is an improvement in the allocation of capital. So this dispersion in MRPK is lower. So we want to test what happens after an expansion in monetary policy shock, and for this, we're going to do the following local projections where we're regressing the changes in the variance of MRPK at the sector level on the monetary policy shock, and we're having different macro controls and sector level controls, and also sector fixed effect. And what we find is what you can see in the figure is that after one standard deviation monetary policy shock, we see that the variance of MRPK falls over time, reaching this maximum decrease of approximately 1.1% after 3 years. And if we borrow the CEPR framework again, a back of the envelope calculation with some assumption on parameters tells us that this monetary policy induced reduction in capital misallocation could raise the FPR by 0.7% after these 3 years. So this is what we see, so to say, at the aggregate level, at the sector level. Now we go to the firm level data. Let's see what happens at the intensive margin. So now we're going to run similar local predictions, but at the firm level, where on the left-hand side, we're going to have the changes in the locked capital stock. We're also going to use the same specification, but with changes in debt later on. But now we're going to focus on investment, on changes in capital. And we have exactly the same controls as in the previous regressions, just that we are adding firm level controls. And what we're interested in is in this impact of monetary policy, this beta 0. This is the interacted variable, which is the monetary policy shock times MRPK. This MRPK is going to be the mean at the sector level. So this is simply the unstandardized. So these are going to be the deviations from the sector mean. So the beta 0 is then going to give us the average response for the average firm in the sector, and then we can understand this beta 1 as the response of a firm that's one standard deviation, that has a one standard deviation higher MRPK. Okay, so this is the beta 0. So what we see, as we would expect, is that for the average firm, after an expansion in monetary policy shock, the firm increases investment. And the peak effect is at year 3. So after one standard deviation monetary policy shock, this increases around 1.7% of their capital stock. But what we're interested in, because of our exercise, is on this differential effect. So a firm that is one standard deviation, that has one standard deviation higher MRPK, they would increase their capital stock but by 0.8 percentage point more after 3 years. And so I know that now it's a mess to click on things, so I'm just going to explain to you what was under this clicking. So this matters because at the aggregate decomposition, so if you see at the aggregate capital stock, actually higher MRPK firms only account for 23% of the overall capital stock. But if we are starting accumulating these increases in capital stock, after 3 years, they account for more than 50% of the increase in aggregate capital. So this differential effect matters for this composition. And then we run like many robustness tests on these findings. So we look at alternative monetary policy shock and alternative ways of adding them up to the yearly level. We have alternative demeaning, standardization, industry year fixed effect, firm fixed effects. We include lag controls. We do this exercise with quarterly data. So where we have a subset of firms that are larger, more manufacturing firms, but for which we can see quarterly level data. And what we do is basically replicate this analysis at the quarterly level, and for this subset, aggregate to the annual level and see whether we get similar results. So to say, just understand whether the artifact of this having to sum up all the shocks to the yearly level is actually driving this. But we find that similar results just have differential effect that's smaller, but this is because like firms are really like large firms, manufacturing firms, so there is less heterogeneity there. So then we go to thinking about firm borrowing, and this is a little bit small, I'm realizing now, I'm sorry. What I'm showing here in each of the tables, in the first part, you're going to have, this is always the first is the average effect, and the second line and the second bar is the differential effect, and what I'm showing here is the peak effect, so the 3, what happens at year 3, okay? Instead of showing you the full dynamics, I'm just showing you the peak effect just as a summary so that I can show you more things. But what we find is that first, running the same regression with the log debt instead of log capital, we find that the average firm increases their debt, but higher MRPK firms are increasing it more. But it is not only on intensive margin, because this is restricting us to firms that had the previous year some debt. But this is also the case when we're looking at the probability of having debt. So the second graph is showing us what happens when at the left-hand side we have the probability of having debt. And then we decompose this into the probability of issuing debt if I didn't have debt in the previous year, or the probability of maintaining debt, which is having debt today if I already had debt the other day. So it's some sort of decomposition of this extensive margin. And we always see that there is the average effect is there, and the average effect is relevant, but there is also a differential effect. So higher MRPK firms actually can have an increased access to the debt markets and to the amount of debt they can borrow. So what we've seen so far is that after this expansionary monetary policy shock, we have high MRPK firms investing more, and it seems that at least part of this investment is financed by issuing more debt. And this is consistent with the idea that high MRPK firms are financially constrained. But for people that work in the literature, you know that these financial constraint proxies are always like a bit, it's very hard to find like empirically something that's a good proxy for financial frictions. I'm not claiming that this is all the solution, but at least this is pointing to the right direction. So what we're going to do is test how MRPK performs against a standard measure of financial constraints in the literature. So what other papers have used are heterogeneity in age, saying that young firms are actually more responsive to monetary policy shock because they're usually more constrained. Cash, for instance, if I have cash, I might just use the cash I have stored on the bank, and then I do not need to go to the market, so I do not react as much to changes in interest rates. We can think of leverage as well, and here it depends on the, I think there's no consensus, but there are some papers saying that if you have low default risk, you are more responsive. Some others say that if you have high leverage, you might be more responsive, so it's not clear, but it seems like it could also be a good proxy for this responsiveness of monetary policy. So what we're going to do is run exactly the same regression as before with the sole difference that we're going to separate firms between high MRPK and low MRPK, so just an indicator in two groups, okay? And then we're going to do the same with age, with cash, with leverage, so young versus old, and this is always with respect to the median of the sector the firm is at. Okay, so every firm is going to be in high or low MRPK, young or old, and the same with all the other variables. And we're going to interact them and interact these interactions with monetary policy, and we want to understand whether these different groups have different responses to monetary policy shocks. So what we see, and let me focus on age just for the sake of explaining, but it happens the same in the rest. So if you see actually young firms have a higher responsiveness than old firms within their low or high MRPK bucket, but it is really high MRPK firms the ones that are driving this response. So old high MRPK firms actually respond nearly 3 times as much as young low MRPK firms. And this happens with cash, something similar happens with cash, with leverage, with this interest coverage ratio. So it seems that actually these proxies of financial constraints or sensitivity to monetary policy, if you want to call it like that, I actually have a lower explanatory power than MRPK. So let me go to the extensive margin now. So remember, like now we've seen at investment, at debt holdings, and now we want to understand entry and exit and the composition of this entry and exit. So the regression we're going to run is very similar to the one we had at the beginning, because this is going to be at the sector level, okay? So this is going to be entry and exit rates at the sector level, where this left-hand side is going to be the normalized entry-exit rate. Why do I say normalized? Because we're going to have the number of entrants or exiters in the numerator, and then in the denominator, we're going to have the number of active firms at t-1, so that we can compare, we have like a fixed point, like a normalized point to compare at different points in time, and also so that we can compute cumulative entry and exit at the sector level. The rest is very similar to what we had in the variance of MRPK regression before. So we have macro controls, output growth, and sector fixed effects. And something that we can do, because remember that we can match this entry and exit with our firm level data, we can know whether a firm is high or low MRPK firm when it entered or exit. So when the firm enters or exit, we look at their MRPK, and then we label them high or low MRPK firm depending on the industry they're at. So we can see this composition of entrants and exiters. Of course, the sum of NH and NL needs to be equal to N, okay? Because the low MRPK and the high MRPK firms, the sum and that are entering, the sum is all the entrants in the sector. So we're going to run this regression for the overall number of entrants and for high and low MRPK, and this is what we find. First, let's focus on the point estimates, so the dots. what we see is that expansionary monetary policy shock is increasing entry rates in the short run, and it is decreasing, although this decrease is not significant, so I wouldn't highlight that, in the third and the fourth period. And the exit rate, we have that there is a decrease in exit rate, and then it goes to zero with this small overshoot in period 3. And quantitatively, this is not very large, okay, because we have this is around 0.20 and 0.11, the highest response, and average entry rate is 5.1%, and exit rates are 3.1% respectively. But more importantly, we see that there are no significant changes in the composition of entrants and exiters, because the light green stacked bar is the contribution of low MRPK firms to the changes in entry or exit, and the dark green stacked bar is the contribution of high MRPK firms. Okay, so in general, the contribution is relatively similar. We test whether they are different or not. In most of the periods, they are the same, and if they are different, the significance is barely there. So we conclude that there are no significant changes in the composition of entrants and exiters. So let me conclude, and I want to conclude because I want to click there, so please be ready. Using the quasi-universe of Spanish firms, we find that high MRPK firms are going to increase their investment relatively more as opposed to the average firm, and they are going to borrow more as well. And we see that there is a small positive effect on firm entry and a small negative effect on exit. But importantly, there is no effect on this MRPK composition of entrants and exiters. And well, we provide some evidence that we think that MRPK seems to be capturing some financial constraints that get relaxed after this monetary policy easing. And the overall effect, which is the first time that I showed you, is that actually this monetary policy easing is improving the allocation of resources in the medium run. And now, if you could please click on the, yes, thank you. So this is just to show you that this exercise, we replicated it because Dimitri and I were part of the ECB forecasting working group and the expert group on productivity. And within this group, we did a micro-distributed exercise where we shared our code and we gave it to other European central banks so that they could replicate this analysis with micro-level data that's proprietary in other national central banks. These were the countries that signed up for the exercise. And what we find are that at least qualitatively, what I showed you here actually is there in most of the countries. So the green bars, what you're seeing is the peak decrease in the variance of MRPK after an expansionary monetary policy shock. And the number that you see there in white inside the bar is the year at which this peak effect occurs, because there is heterogeneity according to the country, but we see that in all the countries, we see this decrease in the variance of MRPK at the industry level. And on the right, you see these orange bars. What you see is this differential effect of high MRPK firms. And what you see again is that quantitatively, there is variation, but we see this positive differential effect in all the countries. So if you can go back. So, okay. This is it. Thank you very much.
Thank you, Beatriz. And now Daria will discuss the paper. And Daria, you also have 10 minutes.
Thank you. So thank you for the opportunity of discussing this super interesting paper. And I also want to thank the ECB, CEPR, and BIS for sponsoring this great initiative. Thank you. Beatrice already explained very well the paper, but what's the main question of the paper? It's asking how monetary policy affects capital misallocation. And the paper thinks of capital misallocation according to the definition in the sense of is clean, also captured by dispersion in the marginal revenue product of capital. And it goes even deeper because it's not only about documenting how monetary policy affects dispersion in this MRPK, but also what are the underlying mechanisms, why that's the case. And the core idea is to exploit yet another great data set on quasi-universal Spanish firms to measure within the industry dispersion in MRPK, and then track heterogeneous effects on investment and borrowings of the firms after monetary policy shocks. And what's great is also not only they can look at the intensive margin, but also at the extensive margin. So hence it's like a tale of two margins. Identification is like using high-frequency monetary policy shocks mapped to the firm year horizon. So what are the main findings of the paper? Does monetary policy affect misallocation? Yes, in a positive sense, because after monetary policy easing shock within the industry, MRPK dispersion falls. And why is that the case? Through which channel? The paper argue with extensive battery of tests that it's about the credit channel of monetary policy. First documenting that firms' investment sensitivity to monetary policy shock is higher for firms with high MRPK, and that this is a better proxy for financial frictions. And then also showing that actually this is happening more on the intensive margin rather than the extensive margin. So this is, of course, a great, important question using excellent data set. And it's also nicely complement the theoretical contribution in another paper of Beatrice. That actually Beatrice presented the other paper at the previous edition of this conference. And in the meanwhile, she managed to produce 2 great papers, 2 human beings, and that's like empirical evidence on women productivity and ability of multitasking. So that's. But there is and why is it important? Because there is a very large theoretical literature on the credit channel of monetary policy, and yet there is no consensus on what's actually a good empirical proxy for that. But even like on the effects of how does and I will say that more, on the effects of monetary policy on the credit channel. The paper does lots of robustness tests. The appendix of the paper is 40 pages, so I'm not gonna talk about yet another robustness test to make the appendix even longer. So let's look at what can be done next with this great data set. And to do that, let me go into the main idea of the paper and think about the theoretical mechanism that is behind that, because that's really like my comparative advantage. So in absence of frictions, all firms should have the same return to capital. But then it's possible to show, and this is done in previous literature, that is if there are policy distortions, and let's call them frictions. I don't want to call them financial frictions because it's much more general than that. There are frictions that can impact on marginal product of capital or marginal product of labor in different ways. There are frictions that can impact on both margin in the same way. And for all these reasons, the marginal revenue product of capital can be different across firms. Why do we care about that? Because that's actually a measure of capital misallocation, and it can be shown that it's like if that's the case, it's like there is a nice formula that linking aggregate TFP to dispersion in this margin. And what Beatrice and the co-authors have shown also in the theoretical paper is that they argue that actually that this
friction on TK wedge, like the wedge is something that can arise if firms face collateral constraints. And actually, even in that paper, there was like a small empirical part documenting that high MRPK firms are more responsive to monetary policy shock. What they do here is like test directly A, C, and partly C, like even like talking more about that. So let me give 3 main comments about this. First is like, we talk about financial friction, but financial friction is like a big umbrella term encompassing like different ways in which like frictions can have an impact on firms' financing decision. And it turns out that the effects of the financial decision on firms' investment, so first is like it's very difficult to measure them in the data, that's something that, but even like the effects of financial frictions on firms' investment, it's not something, because it can go in the opposite way. This is something that it's shown in Ottobelli and Wimberry. Why? Because it's like financial friction make marginal cost of firms upward sloping, and through that effect it reduces their sensitivity to investment to monetary policy shock, but then monetary policies can flatten that curve and that increase their sensitivity. So, and if you look at the characteristic of the firms that have high MRPK in your sample, actually they also the ones that are less levered. So I wonder if that's really squares with the idea that the financial frictions that is in the background is like a collateral constraint, or if how often is, whether there is other financial frictions in the, for example, how common is like on Spanish data earnings-based constraint, because that's not really a story about collateral. Even if like, okay, this is, we don't know which exactly financial friction, but there can be even more friction. I'm not saying that financial frictions are not important, but maybe there is the interaction between different friction. That is like, remember, in the original papers, it's about friction in the capital, but also in the output. And it could be that dispersion in this revenue of capital reflects markup heterogeneity. They can reflect also like different level of adjustment cost, so more like real frictions rather than financial friction. Could be the case also that capital elasticity within industry could also generate the same dispersion. And in general, whatever is under the umbrella of output distortions can create dispersion. So again, it's not about testing for and showing robustness about it, but these are also important channels that you could check in extensions of the paper. And then I was thinking, I was a bit surprised about the results of extensive margin, because I thought that extensive margin in theory could be very important. And then I thought that maybe it's related to the fact that the effects on the extensive margin could be state dependent. So there is a literature showing that, for example, productivity dispersion is greater in recession rather than booms. There is another paper also like of economists here, whatever economists here at ACB, showing that asymmetric channel of monetary, the credit channel of monetary policy can be asymmetric, so different if it's an easing or raising rates. So maybe it could be interesting for another paper, not for the appendix of this paper, to check at the state dependency or like comparing like easing or tightening of monetary policy. So this is like a great paper, broadens our understanding of monetary policy transmission using excellent data. There are some open questions and possible extension about which exactly financial frictions or which friction is really relaxed by monetary policy. You could decompose between and think about the decomposition between markup and wedges. And then I'm a big fan of asymmetric effects of monetary policy, so that's also something that could be interesting to do. Thank you.
Thank you, Dario. So, Beatrice, I will let you reply to Daria.
Thank you very much for your discussion. So yeah, actually I forgot to mention, but this is very related to my theory paper. In that paper, this misallocation comes from financial friction, but this is like a very stylized model because in the end, so actually we took out all the empirics because of the, actually the referees told us to do so, so we're focusing on optimal monetary policy. So now that is really focused, so we have a stylized model that we know that will not match the data exactly because of what you're saying, but we're using this as a laboratory to explore these implications for optimal monetary policy. And so thinking about what are the sources of this misallocation, as you correctly point, financial frictions can cause this misallocation within sector, but also different capital adjustment costs, different capital elasticities. This is one of the reasons also why we're focusing on within sector, because capital elasticities vary a lot across sectors, so we're focusing on within sectors. And what we think, so we're not claiming that all the dispersion we see at the sector level comes from financial frictions. There are 1 trillion things, as you were saying, but what we're seeing when we have this expansion of monetary policy shock, something is moving. So we think it is hard to believe that are these structural things that are changing at the short run because of this monetary policy shock. And because of the test we did, we think that what is changing is financial frictions at the short run, with a lot of other frictions operating for sure. This easing versus tightening and asymmetries is super interesting. We did try, but since we have we have to aggregate at the yearly frequency, then if we start separating with it's it's hard to learn anything. So hopefully, if we could have better data, maybe we could do this, and this would be super interesting. But so far, it didn't work. And regarding earning-based constraints, actually I have another project where we're looking at the characteristics of debt for Spanish firms with the credit registry data. And actually, I think it was between, I forgot now the exact number, but between 70 and 80% of debt is uncollateralized loans. So there is a lot of earning-based constraints if you want to think about it. So, I mean, for this project, I don't think we're going to exploit, but this is a very good idea, I think, for the future, to understand how these different types of debt can react to monetary policy, also depending on the type of collateral even. So I think this is a very promising avenue, hopefully, for future research. Thank you.
That's great. So, and now we can take a couple of questions. Where there? And then Elena.
Super interesting paper since you talked about earnings-based constraints. Victoria Vashna showed using Spanish data that these debt with earnings-based constraints where cash flow-based debt is more sensitive to bank lending shocks and so on for a variety of reasons. And if it's true, then you can think about sectoral heterogeneity, especially as the economy becomes more intangible, intensive. The development of these industries are very important. That's one. The other thing I was curious about, there was work showing there are cyclical variations in misallocation in general, that in booms there are more reallocation than in recessions. So I'm curious how much of what you see is distinct from the general business cycle fluctuation in reallocation, which has implication potentially for policy. Like your first couple of slides gave people, kind of prime people to think that maybe monetary policy decision makers need to think about this as an additional channel of monetary policy transmission. But it could also be that it's part of the normal course of stabilizing the economy, and these are not byproducts, but natural consequences of the normal stabilization of monetary policy.
Thank you. Yeah, super interesting. I'm intrigued by your extensive margin results where the exit rate decreases for both high MPK and low MPK firms. That's correct, yeah? Mm-hmm. So is it due so low MPK could be explained, relatively simply. The high MPK, is it a crowding out effect? I mean, can you investigate that? Is it maybe within sectors or something like that? That would be interesting. And then Daria pointing out there's also this maturity debt effect potentially. I wonder if your high MPK firms, if they are kind of, I don't know, I don't know, venture capitalist firms or innovative firms in some sense. There could be also a correlation between the short-term debt for some lack of trust by some types of investors, maybe the banks, or I don't know if you could explore a little bit more of the link between maturity and your high MPK.
And Jan, last question from Jan.
Thank you. Very interesting paper. So I'm wondering whether you can also check like other inputs, like margin product labor or the intermediate inputs. What happened? Thank you.
So if there are no other questions, I also, going back to Helene's point, if you could share some more insights with us about what type of firms are these high-end PRK firms?
Okay. Well, can I? Okay, yeah, thank you. So I'll try to go in order. So thank you very much, Joran, for your comment. Yeah, this Ivashina paper actually uses this credit registry data, so it's very similar. If I remember correctly, I think they were looking not as a monetary policy shock, but it was interest rate changes. But definitely, we could think about this sectoral heterogeneity, this intangibility, at least at the sector level. We try to. We're actually not looking at intangibles here because at the firm level data, since also we have like the universe of firms, it's self-reported data, it's a bit, but this is actually something that's very interesting that we could check at the sector level. Regarding this cyclical variation in misallocation, it's right. So to the extent we can, we try to control for it, introducing year fixed effects. We have this, this robustness having industry year fixed effects. So hopefully part of this cyclical variation is captured by that, but arguably not everything, that's true. So at least if you have any idea of any other way we could control for that, it would be great. Helene, regarding the exit rates, so why is it that high MRPK firms are exiting as well? That's a good question, and that I would like to know. So actually, so if you think about low MRPK firms, you think like these low productivity firms, the threshold moving. So this is the standard story we would have in mind. But then why are these high MRPK firms exiting as well? So we haven't. So I don't have a good idea of how to explore this. If you do, please tell me. It could be because of. I don't know, because maybe like there is also heterogeneity in how much leverage they have or not. I don't know. So this is something very interesting, but which I'm not sure how to tackle, honestly. Regarding differences in the maturity of debt or other heterogeneity, with this credit registry data, we can actually have a look at this, and this would be something super interesting. Also, like thinking of Ottonello Winberry and these papers that look at this, and there's also this paper by Junger et al. That they're looking at this, the paper that you were. So yeah, this is super interesting, and with this data, we could have a look at it. Regarding venture capital innovative firms, there might be some, but I don't think there are that many in this data set. Because this is like the universe of Spanish firms. So there are some innovative, but honestly not that many, unfortunately, and not that much VC either. So even though there might be something, I don't think there's much there. Though, I mean, if we had like alternative data like PitchBook or other data like that, where you can see venture capital money, and you can link it to the firms that are having this, which are not many, but then maybe you could see this. And yeah. Regarding the heterogeneity with MRPL and intermediates, this is actually something interesting. So we do look at TFPR, so the overall measure, not at MRPL, but this is something we could look at and it would be interesting to see. And regarding these high MRPK firms, so we do have like this summary statistics. So this these are actually, there's not that much differences in age, so they're relatively similar in age, but they have, like high MRPK firms have low leverage, as she was saying, have higher cash, so it seems that they look like high intangible firms a little bit when you see like the summary statistics, but yeah, so thank you.
All right, so we are perfectly on time. Thank you very much. And now we move to the last discussion. Claudiana is already ready. She's ready. Everything is done. The discussion on the systematic origins of monetary policy shocks with Claudiana Isrefi and Francesca Monti. So Claudiana, you have 25 minutes.
Thank you very much, Caterina. I also would like to thank the organizers for putting this paper in the program. It has been fantastic so far, and I also congratulate you for resisting up to now. This is a joint work with Lukas Hack and Matthias Meyer. I'm now at the ECB, so it's first time actually that I'm saying this, so I have to get used with this. This means that these views are only our views, and they do not represent the views of the European Central Bank or the Euro system. So we heard two papers about monetary policy shocks, and the story evolved in other on the transmission. So this paper actually is going to bring the attention to monetary policy shocks themselves, how we identify them, and what are the challenges with regards to this identification. Is actually fair to say that empirical monetary policy shocks are the backbone of monetary economics, are the bread and butter of many of us that work on monetary policy questions. They are used to assess the effectiveness of monetary policy. They are used for structural estimation. They are also used to do counterfactual analysis. What if there was this regime of monetary policy regime? What if there was this other monetary policy regime? And as for to do this job, let's say the best possible, we need the best monetary policy shocks. So we need well-identified monetary policy shocks, which means that they should capture unpredictable and exogenous variation changes in policy. They should not be predictable by other, let's say, macroeconomic shocks. Let me start with a simple monetary policy rule, just to put things in perspective. So we have, let's say, a policy instrument, interest rate. Then the central bank is going to respond systematically to the inputs to the rule that, let's say, the things that the central bank cares, inflation, output gap, unemployment, so in a systematic way. And then there's this extra part, which is the deviation from the systematic monetary policy, which we call a monetary policy shock. Now, note here that I'm allowing that this systematic response to vary over time. So we have a phi t. The conventional empirical strategies that have been used in the literature to identify monetary policy shocks typically assume that the rule is constant. So the systematic part is not varying over time. And we have these assumptions in identification strategies that use linear Taylor rule regression, so the famous Romer and Romer type of shock. We put all the information that the central bank knows and cares, and what is left unexplained, the residual is the shock. We have this assumption in linear structural VARs, independent of what type of restrictions you are using for these VARs. But we also have this assumption in high-frequency identification. Now, the question is, can we identify true monetary policy shocks when systematic monetary policy actually fluctuates over time? And the simple answer is no. We will have a contamination, and said in very simple words, we are going to put in these shocks, we are going to mistake intent for surprise, where intent is this, let's say, variation in systematic monetary policy. So what we are going to do, we're going to do two things. First, we are going to show, in theory, this contamination problem. We're going to show that conventional identification strategies, they are going to yield to empirical monetary policy shocks that are contaminated by other shocks. They are predictable by variation in systematic monetary policy, but this doesn't end there, that we just have, let's say, contaminated shocks. But when we want to understand the effects of monetary policy shock in the economy, we're going to get biased results. So we're not going to identify the correct effects of monetary policy. Then we're going to show some empirical evidence of this contamination and this bias using, for the case of the US, so for the Federal Reserve, and we're going to use, let's say, some very famous empirical monetary policy shocks, like the Romer and Romer, some improvement on the Romer and Romer, Miranda-Agrippino shock, and we are going to show that these are predictable by variation in systematic monetary policy. And we have a crucial measure that is this variation in systematic monetary policy, which is represented by the hawkishness of the FOMC, which varies over time as members rotate their voting rights or, let's say, resign, or there are new nominations. So this is going to bring this time variation on who is deciding monetary policy. And we're going to show that these shocks actually are predictable by this time variation. Then we are going to clean these shocks by this predictable part. We're going to get these new shocks and showing that the effects on the economy of these shocks actually are stronger and faster. So we have not so much lags of monetary policy than we previously thought. Now, with regard to the literature, this is a long business of 30 years of identifying monetary policy shocks, so great contributions in the literature. And this challenge that monetary policy might vary over time, this challenge, of course, have been recognized in the literature. What we are bringing here, we are formally characterizing this misidentification and proposing a solution for it. Also, the literature has, let's say, works that tries to work with this time-varying monetary policy as a latent variable. But this literature actually shows very clearly the challenge of identifying the systematic part of policy from the data and the modeling choices. We're proposing, let's say, a measure that is outside of the model, and we're going to show that this time variation actually is going to give us very sensible and important results. Very briefly on the theory part, what happens if we apply conventional identification strategy in an environment when the systematic monetary policy is time varying? Again, the monetary policy rule that has this phi t that varies over time, but what these conventional strategies are going to use is a constant rule, okay? So we are going to estimate this EM, empirical monetary policy shock, and this, let's say, this type of regression applies to Taylor rule regression, linear VAR models, and high frequency has a similar problem, but I will just speak about it later. Now, if you combine these two regressions, you can do some, let's say, calculation and arrive at this proposition where the monetary policy shock, the empirical monetary policy shock, will be the true shock, the WM, plus something else. This plus something else, there are two wedges, which one edge is the first that if we are using OLS, we kind of knew this problem of misidentification. Using an OLS, we might have hard time to get the right phi, this average response, because of identification issue. XT also might be affected by the monetary policy shock. The second wedge is what we are kind of bringing forward is this now we are going to put in the residual the interaction of phi t with xt. So this interaction now will show up in the residual, and this is the contamination that we are bringing forward through this time-varying systematic monetary policy. Then you might want to do some impulse responses. So to use this empirical monetary policy shock, assume you are interested on the response of inflation to the empirical monetary policy shock. We do a local projection. However, now we know that the empirical monetary policy shock contains the true shock, but also these two other parts that are problematic. So this leads to bias in the RF, in the impulse responses. So this means that the monetary policy shock actually would depend on macro shocks through pi t, but also will depend on the interactions of macro shocks with the systematic monetary policy. How to kill this? You want only if this phi t is 0, so there is no time variation, or phi t is exogenous and xt is exogenous at the same time. So then it means that monetary policy does not affect the economy, so economy moves for its own reason, and monetary policy moves for its own reason at the same time. Now we have a testable prediction whether this interaction explains some variation in the empirical monetary policy shocks that have been estimated in the literature. I said that we have this problem also in high-frequency identification. What is the problem here? Now we have, let's say, the interest rate changes around the monetary policy event. So we have the expectation, then we see the monetary policy news or decision, and then we see the, let's say, what is the interest rate after this decision. We do this change, and this change, based also if we can use the regressions that we had before, represent the true shock, but also two other components. One is the so-called update about the XT, which we call information effect, central bank information effect, and the other part is update about phi t xt. So it's update about this interaction. Assuming that there was no update about the data, so markets were not surprised about the data, so there is no information effect, that what remains is that market actually were surprised on the change, that the rule has changed. So they had a perception on the phi t, and after they saw the decision, they think, the rule maybe was different. So now you see that the empirical, this monetary policy price is contaminated by variation in this systematic monetary policy, even in these very high frequency events. There is recent literature actually that accounts for this, or at least mentioned that there is this extra component in this monetary policy surprises. So Bauer, Swanson, Rachinsky, Karate, they speak now about this Fed reaction to news. How they deal with it is not so they have not arrived yet there to deal with this part of the surprise. We are also not yet there, but we are working on it. Let's go now to the empirical analysis very fast. Now we know what is the prediction. We will get some of these shocks, Romer and Romer shocks and others, and we will see whether this phi t, this interaction with systematic monetary policy and inputs to the rule have some explanatory power from these shocks. But before, what is our measure of systematic monetary policy? We start from who decides monetary policy in the US. And these are the members of the FOMC. These are 12 voting members, 7 from the Board of Governors, 5 regional Fed presidents. These people are not static. So we are studying FOMC since the 60s. There have been more than 140 people that have been sitting on that table. But so people rotate, which means preferences rotate, which means that who's deciding monetary policy actually is varying over time. And one reason why these people rotate is the voting right. So every year, 4 regional Fed presidents, they rotate their voting right, which is with a mechanism that is completely exogenous to the state of the economy, which induces plausibly exogenous variation. We have people sitting there, but how to use them for our purpose? I have built a measure of characterizing these people as hawks and doves with respect to the dual mandate, where a hawk is a member that leans more towards, let's say, low and stable inflation, and a dove more towards supporting growth and employment. And I'm following these people before the meeting. I'm looking at the media. What is the perception about this leaning for each member? So in a meeting, before the meeting, we can do the aggregation of preferences as I have, let's say, 12 members. If you are a hawk, you get +1. If you are a swinging hawk, because I also have people that swing over time from hawk to dove, you get a lower weight. You might be completely unknown. You just started your FOMC stint. Nobody heard about you before. You didn't have a speech before. You probably were in the private sector. There is no news that tells something about your policy preference. So you start with a 0, and so on. So we aggregate these preferences, and this is our phi-t, so our measure of systematic monetary policy. Now, this phi-t, let's say, is out of a model, which for us avoids specification of a particular rule. So we are studying FOMC for 60 years of data. There have been different policy instruments. So a lot of has happened in this time. So we're saying we don't know the rule, but we know the hawkishness of the FOMC. So we can apply that as our measure of systematic monetary policy. Of course, these are perceived preferences, and I have done a lot of validation in previous research to show that these perceptions, actually, they match what we can observe later, because I'm seeing these perceptions in real time. And then later, we see their votes, we see their forecast, we also can see their descents. So I can match and see that a perceived hawk is actually one that usually will descend for higher rates and so on. Then we have other validations that these preferences actually are linked to early life and to their education, so it's something quite persistent, and that this variation in hawk and dove scale can explain a sizable variation in how different shocks transmit to the economy. So we have evidence that for government spending shocks, but now in a revision we have evidence that actually it also matters for how oil price shock transmit to the economy, TFP shocks, so this is really powerful. This is how the measure looks like. In red is the hawk-dove measure for the full voting FOMC, and in the dashed line is the measure for the rotating members. And you see that it varies a lot over time. And one reason is because there is this rotation of voting rights. Now, let me use this measure and go to Romer and Romer, the seminal Romer and Romer shocks. And although now, today, we just spoke about monetary policy surprises, but keep in mind that for many other countries, it's not possible to construct monetary policy surprises. So we still have to use let's say, the methodology of Romer and Romer, assume that there is a reaction function, put information to it, and get the residuals. So this is what they did. So they put green book forecasts, they get the residuals, and now what we're going to do is take these residuals and put these interaction terms and see whether they have some explanation for these Romer and Romer shocks. We're going to also add some lags with the idea that maybe monetary policy, we know actually from let's say, FOMC members saying themselves, when I'm going to the meeting, I'm actually going to position myself for the decision of the other meeting. So I want to influence the colleagues for the next decision. So we add some lags. We also look at the full hawk-dove measure or just the rotating measure. And we're going to look at different samples. And what we show here is the R-squares of these regressions for when we use the full hawk, the rotation hawk, for different samples, subsamples, and different lags. Now, what we see that actually we get quite high predictability of these shocks. And let's say the best model or the best regression is the one with the rotation of hawks and with lag 1, where we can have up to 50% explanation of these Romer and Romer shocks. we also see that which are the quantitatively important regressors, and it is really the interaction. So the interactions of hawk with XT. So not just the hawk itself, the level, but is the interaction what is important. And we show this for other shocks, not just Romer and Romer shocks. So another shock is Aruba-Drexel, which is a refinement of Romer and Romer shocks, with adding more information from Greenbrook forecast. And the Miranda-Agrippino-Rico shock, which is coming from the VAR, where the shock is actually informed by high-frequency monetary policy surprises as an instrument. Now we are going to clean these shocks and show impulse responses to these new shocks. For interest of time, I'm going to concentrate only the Romer and Romer shocks. So we're going to clean the Romer and Romer shocks and show the impulse responses to both shocks, the new and the original shock. We're going to focus here on the sample 1983 to 2007, because this is considered in the literature as a problematic sample that brings puzzles, output puzzle, price puzzle, and so on. So here are the results. I'm going to show you two panels. The first panel, I'm going to concentrate in the red. These are the responses to the new shock, and in black is the response to the old Romer and Romer shock. In the second panel, I'm going to highlight the uncertainty or confidence bands of the old shock. So you can see also the confidence around these responses. So we have a tightening shock. We have, of course, we have standardized them to be similar. So we have 100 basis point increase, like the maximum increase of the Fed funds rate. And you see that the new shock has a more transitory response. So we have a tightening that comes back much faster than the old shock would suggest. However, we get a much stronger GDP response with the new shock. So we have almost the doubling of the effect of the dip of GDP response. And if you see also that with the old shock, this response actually would be almost insignificant. So this drop in GDP. What happens with prices? Again, we have a strong response of prices with the new shock, but also a much faster response. So with the old shock, we would see a response after 2 years. So there are really these long lags of monetary policy. With the new shock, the prices are going to react actually in 1 year. Now, we have a bunch of other results. We decompose the Romer and Romer shock to see actually what is the part of systematic policy that is biasing these responses. As I said, we have Aruba-Drexel shock, additional variables, and many, many others. And if one can click on the last one, on this go, one can help. On the last, yes. So this is the responses if actually we are going to just include some lags of XT without interacting with the Hogg-Dove measure. You see, there's no difference. So just adding more information set to this regression is not going to clean the shocks. Why I wanted to show this, because this is important to understand that what is this interaction telling us? It's telling that if it really matters, so if you have the data, who is looking at the data? Are we looking at them with hawkish eyes or with dovish eyes? And these hawkish and dovish eyes will vary over time. So if you see a 4% inflation, this will be different for a hawk than for a dove, and they would want to react differently to it. So this is really important. So it's not just the data, it's who is looking at the data. And usually this information is missing in our typical, let's say, regressions that don't have this information that we can get out of the model. So if you go back. Great. So just to conclude, I showed here that in theory, this presence of time-varying systematic monetary policy poses challenges for conventional strategies used to identify monetary policy shock. This is not actually only about monetary policy shock. You can apply this very well to fiscal shocks, because that is as well, if we consider that is a reaction function that may vary over time, the same problem would apply there as well. And our evidence highlights that these challenges actually has important importance, so it's relevant for this, how we think about how fast monetary policy shocks transmit to the economy and how forceful. And the new monetary policy shock that we provide shows that monetary policy transmission in the US is quicker, stronger, and more significantly than we previously thought. Thank you.
Thank you, Claudiana. And Francesca, you have 10 minutes for your discussion.
Thank you. Thanks a lot for inviting me to discuss this really nice paper. Let me start by giving you a brief overview. As I'm telling you, it's a really nice paper that starts from a very insightful and simple but overlooked observation that indeed, if you have a monetary policy rule that is time varying, but the econometrician estimates a non-time varying Taylor rule, then you're going to get estimated monetary policy shocks that will be confounded with the time variation. Okay, and so I'm just showing you effectively what Claudiana was showing you before, where, to get a sense of this confounding effect, you just put together the time varying policy rule with what is estimated by the policymaker, and you're going to get two effects, one that has to do a bias, if you want, that has to do with simply the estimation, the fact that we might not estimate phi perfectly, and then something that has to do with the time variation and the difference between what is expected of this time variation and, and the time variation itself. So that part will be something I will come back to, and the expectations on it, because it's something that I'm interested in and that I feel is slightly missing in the paper. Just to summarize, so the paper proposes to use this hawk-dove balance to measure the time variation in the policy rule, and then they show that there is contaminations of various shocks that are used in the literature, the Romer and Romer shocks, but also the Miranda, Grippino, Enrico that are high-frequency shocks. And they show that they can be predicted with this hawk-dove measure, and therefore propose a new identification strategy that cleans from these effects of systematic changes in the monetary policy rule. So let me start by giving you an overview of what comments I will have. I will have 3 sets of comments. So the first is really about the nature of this time variation in the Taylor rule. What does it stem from? I will ask or probe a little bit more about what this hawk-dove balance measure is picking up. And then I'll have some smaller points, which I'll probably not have the time to get to. Okay, so let me start with the source of the time variation. As also Emi Nakamura, for example, pointed out in Jackson Hole this year, Taylor rule, is probably more descriptive than normative, and indeed seems to be fitting mainly during the Greenspan era. So this suggests that indeed there is time variation in the Taylor rule. And if you want to kind of have a, think about how monetary policy maybe is set, there's more, you could think about policymakers having a loss function on output deviations and inflation deviations, where lambda is the weight on output deviations. And then, now I'm kind of very simplifying it a lot just to give you the flavor of the reasoning behind, but if you do optimal policy without commitment in a standard New Keynesian model, well, then this optimal monetary policy implies a policy rate that delivers, this relationship that you see on the slide between output deviations and inflation deviations. And this relation depends indeed on the central banker's preferences, lambda, for output stabilization, but also on the slopes of the Phillips curve. So now if you were an econometrician doing your regression on the Taylor rule, you would find time variation in your coefficients, but this could be due to variation in the lambda, policymakers' preferences, but also time variation in the kappa, the slope of the Phillips curve. Okay, and indeed, considering that there has been a debate about the time dependence and time variation in the slope of the Phillips curves, I'm just asking whether can more be done to say whether really this does come from the lambda or other elements of the economy that are also having time variation. The other point that I want to make, which is still about what this time variation is about, has to do with what the agents know. So in your model, you have this time variation phi t, but everybody is fully aware that there is this time variation. But this is a strong assumption. And actually, it's more realistic for me to think that agents would be learning about this, extracting a signal. So in this sense, misperception about the rule. And that's exactly what the Bauer and Swanson, for example, talks about. So they posit a drift in the Taylor rule parameters, as you do, but then there's also systematic underestimation of the Fed's response, informational rigidities. I discussed a month ago Rico and Savini's paper, who argue that this, this drift effect is actually only second order. There's another way, and this is what I find more interesting, but of thinking about misestimation of the Fed's reaction, where you can think of different confidence in the public signal between the public and the policymakers, which generates heterogeneous priors. And so with my co-author Riccardo Mazzolo, we have a paper where there's time-varying public confidence about the implementation of the monetary policy rule. And we implement this in a model with, it's a simple New Keynesian model, but where households are ambiguity averse. And there you get first-order effects. Effectively, you have ambiguity-averse households that base their consumption-saving decisions on a distorted belief of the prevailing interest rate, which is going to give you both the belief of the interest rate that is below the one actually implemented by the Fed, as found, for example, by Bauer and Swanson, but also it gives you implication about long-run inflation expectations and trend inflation that match the data. And so my point being, I think the perception about the rule are really important, and it could be that the time variation is coming from that. The other point that I want to make is about the Hawk-Dove balance, which, on just a cursory kind of look, does seem to be moving also with the business cycle. The other point that I want to make is that I'm not sure that an average of the opinions of the FOMC is really necessarily representative of ultimately what happens with the decisions, because there is, influencing and, consensus building, etc. The last point that I want to make regarding the Hawk-Dove balance has to do with the fact that when you build this measure based on newspaper, on the perception of the newspaper of what these central banker preferences are. But actually, you could probably go ahead and use the speeches directly, which might give you a better measure of how hawkish or dovish these members are. So on the one hand, I think the measure you're using really points to the importance of actually accounting for perceptions and misperceptions. But also, the point that I want to make, and because I've been playing around with these speeches, is that actually if you use the text from the speeches, you can also
clean. You can use the text from the speeches directly to clean some shocks. So I had been playing around with this for my discussion of Giovanni Rico's paper, so I'm showing it to you here. But just to say that, when you include a very simple net negativity sentiment score from Fed speeches and testimonies, you can also, see that the sentiment indicator predicts the Miranda-Agrippino shocks, and you can get a series for the shocks. So the Miranda-Agrippino, the original one is in the blue, and the red one is the one that is cleansed with the speeches. Also, it was also a new measure of the shock, and also gives you impulse responses that, remove some of that bias. And so with that, I have some smaller comments, but I'm going to leave it at that. I'll leave you with, just to say this is a really nice paper with a really nice idea, simple idea behind it. Yes, thank you for inviting me to discuss it.
Thank you, Francesca. And Claudiana, would you like to respond to Francesca's point?
Thank you very much, Francesca. Actually, I'm happy that you also had these comments, because we have thought about them, and they are important. So I will go maybe to some of them. So what is the source of variation? Actually, for this project, the source of variation doesn't matter much, because for this phi t xt, for the interaction, this contamination happens independent whether this phi t is moving for exogenous reasons or for endogenous reasons. So if, let's say, there are shocks in the economy and they are affecting the phi t, that will stay in the, actually it makes even harder to kill this interaction. And if we go then to the data, yes, actually a good feature of the Hogdorf measure is that a part of it can actually respond endogenously to the state of the economy, maybe not through the, let's say, the Phillips curve example, but something similar. Let's say we have a president that wants to let's say, to lower interest rate and going to nominate members that will be dovish. So this is one channel through how the state of the economy can enter in the FOMC. But then we have this other part, which is the rotation of regional Fed president that is supposed to bring us some exogenous variation. But for the question of contamination or not, the source of the variation doesn't matter. But whether actually this Hogdorf is varying over time, it is varying a lot, and we have shown that in several validation exercises that it explains Fed fund rate changes, it explains how shock transmits to the economy, so this variation is important. Now, what agents know about the rule, I think this is a very important point, and it's true that in the theory model, this phi t is assumed to be observed and to be the perfect one, and not the, but in the data, so the measure that we have actually is the perceived measure. So it's the perceived measure as constructed by media, and if media and market know, it's supposed maybe that also consumers have seen or can do this calculation. So in that sense, it's a perceived rule, and maybe at time this perception might be further from the true rule. And, but as I said, we have a lot of validation that this perceived rules actually matches very well some policy decisions, like how they descend, how they forecast, and what preferences they have, what interest rates they prefer. But these are only when you read the transcript, so we don't know in public. The other one was, I think, which is very important to learn directly from the speeches. So this is very important. Actually, media have been very clever to do that since the beginning of the times. So in the 60s and 70s, when monetary policy decisions were not known, speeches were one of the main sources of information about media to form these perceptions of who is who. So I can think always, I have in mind this quote from New York Times that Paul Volcker had a speech in a university, XYZ, and he said, inflation is our #1 enemy. So in a sense, media is doing the job that now we do with machine learning. What they were doing at the time is getting all the information that they had about these people, what they speak, what schools they did, who was happy about their nomination, who voted them, the liberals, the conservatives. Then 1 year later, they would see their votes. So speeches, all this information is actually what forms the perception about a member. And I'm very happy to see, actually, that this is another validation that then how they speak, it matches with, so we'd expect that a hawk, on average, would have more hawkish speeches, and a dove, on average, would have more dovish speeches. However, we also have to be careful, and media is very careful. So there are times where a dove has a hawkish speech. It doesn't mean that this dove changed and became a hawk. And the media is very careful to see if this is a change of heart, a hawk turned dove, or is it a change of circumstances? So having a dovish speech from a hawk or a dove having the opposite, this is not going to change the type of the policymaker. But of course, hawks will vote for lowering rates, doves will vote for hiking rates when the state of the economy will demand that. But I'm very happy to see that speeches, like if you just get the raw speeches, they predict, and this is what I would expect, that there is a link between being a hawk and how they talk. So thank you very much.
So great. Now if there is any questions, Fiorella and then Anna.
Thank you, very interesting. I completely see what you're doing with these Romer shocks. It makes a lot of sense, but I'm a bit, maybe I didn't get it. Why is this a problem for the high-frequency identified shocks, where you just have the 30 minutes and then you don't care? Maybe the phi has shifted a lot, but you're not capturing that. You're really identifying what else is happening.
Yes.
No, wait. We need the micro.
Just checking how your shocks after cleaning behave compared to those high-frequency identified shocks would be nice. Thanks.
So the point that you are making about the time variation of the systematic response is super interesting, and it's a theoretical concept. But then you're using the US as your laboratory, so you're using some institutional framework, some institutional features of the American monetary policy to test that is time varying. So I was thinking of the euro area and whether we can also think of time variation in the systematic response of the ECB monetary policy, and whether there are some features that could give us that.
We have a third question by Christine.
Is this on? Yes. Can you distinguish between a real change in the monetary policy Taylor rule, or perhaps the media misunderstanding what they are saying and categorizing this as dovish, even though it shouldn't be, and its mistake is driving some of your results? This is, I thought Fiorella will ask this question, to be honest, because it's related to her work.
So Claudiana, you have a couple of
yes, I thought there were others. Okay, thank you very much for all these questions. So what is the problem with high-frequency shocks? So the problem actually is I don't have now the slides to show, but the idea is that even in this, so this monetary policy surprise that we are getting in this very tight window is going to show you these three elements that have been discussed in the literature. So one is the true surprise. The second element is that maybe the central bank had some superior information that was revealed, so this information effect, but then there is some extra element that maybe there is a change, because these surprises are based on the perceptions of the market. Maybe the rule changed. So they call this Fed reaction to news, but this means that actually market thought that there was a rule in place before the decision. Now they see the decision, and this looks like there was another rule. In our language of the hawk and dove, we have not worked this, and we plan to work with them. In our language, this could be that there was a situation where maybe we had a tight balance of hawks and doves, and the market actually could not assign which rule will prevail the decision. Then they see the decision, and they see, it was the rule of the hawks or the rule of the doves. Or it could be that they were in a situation, there are many of these unknown people, so you don't know actually, you are more uncertain about the rule before the meeting, you see the decision, and now you change your perception on what was the rule. So this is how we can, let's say, put some structure on these rule changing, even in this very tight window. Institutional features, actually the specialty of the FOMC is rotation of voting rights that happened for the whole year. We have this rotation also for the ECB Governing Council, but it happens at a meeting frequency. So this doesn't allow maybe room for these big bargainings and coalitions. Let's just say that probably we can lock some for the whole year. But of course, one can do the hawk and dove story also for the Governing Council. It's a bit more difficult for different reasons, but probably then we can go to this speech. If we cannot, to say it simply, you can say you're German, you're a hawk, you're Italian, you're a dove. You don't need to read all the newspapers. But if you want to be a bit more academic, maybe I cannot read, let's say, all newspaper in German, in Italian, and so, but we can do the proxy of doing the hawk and dove from speeches, and there we can get some average hawkishness. Yes, it is time varying because members also Governing Council, they change. So there is new members. There is also swings, if I can use. So there's members who are switching, but there is time variation also in the Governing Council. Maybe not as often, but if we knew the votes, it is much often because actually the voting rights are changing every meeting. So it would be even more higher time variation. Can you distinguish if the rule really changed or media actually? This is the question. So
yeah, you have minus
2 minutes. Okay.
So just
okay.
Quickly wrap up.
As I said, this is the perceived measure, but all these results and validations show that actually those perceptions are pretty close to how they decide. So there might be times when they are not close, but on average they are doing pretty well.
Great. So let me thank the whole session. Thank you very much, Francesca, Claudiana, Daria, and Beatrice. And now we are at the end of this conference, and we would like to take a couple of minutes to say goodbye. So I will call on stage the organizing team, starting from my wonderful colleagues, Agnese Leonello and Carolina Villegas-Sargent, who are, who apart from being very shy, they fully shared the joy and many pains in being the local organizers this year. And then I would like to also call on stage the person thanks to whom this conference became actually an annual event, Fiorella De Fiore. And finally, I would like, oops, before she dies, let's see, stay still, please. And then finally, a role model for all of us, and the person thanks to whom we are here today, Ellen Ray.
Thank you so much. Well, it's me who is thanking, obviously, all the crew here and also all the participants, and very importantly, also the staff of the ECB in general for the great hospitality, and also the CEPR staff. So extraordinarily grateful. The only other thing I would like to say is that what's absolutely great about these conferences is that you get to meet the next generation of these young ladies economists, and it was, as usual, fantastic. When I look at the work, at their papers, their discussions, their posters, it's really great. And so I'm not worried about the next generation. And all I want to say is keep at it, right? In macroeconomics and finance, we do need a lot more female representation. So please keep going. You are really bringing a lot to the profession and to society in general. And I will finish by next year in Rome.
So 1 second, but before we close, let us also call Despoina, Cristal. Not sure that they don't pay attention to us, but okay, all the trainees who... Yeah, Cristal! Despoina, Cristal, Petra, please join us. Now you know who was sending you emails all the time. And Anna, Sofia, Ludovica, Trixie. This is the team of students who has been supporting us these days. Don't try to laugh. And finally, also a big thank to all DGC event team, to Anya, Letizia, Stefan, which is not here today, and Nasser, who is hiding somewhere, but he has been the one taking care of everything and bearing with us for many months. So a big thank to the whole team.